as well. You could potentially see that show up in the payroll survey, which is based on, I believe, on this week.
Got it. Adam, thank you, sir. Adam Cummins there of Moody's Analytics on the economic fallout and some of the difficulties we might see in the state of Florida. If you're watching the Fed speak at the moment, one individual that might be worth paying closer attention to, Raphael Bostic. Many of these states that have been hit fall under his coverage, the Atlanta Fed president. He'll be speaking a little bit later at the Builder Developer Lender Council at the Greater Atlanta Home Builders Association monthly meeting. I'll get all of that out at 8 a.m. Eastern time. So just look out for some comments from him and see if he addresses some of the questions we've got at the moment about the economic fallout of these hurricanes. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Pentagon says a U.S. visit by Israel's Defense Minister Yoav Gallant has been postponed. Bloomberg has learned it's because of a last-minute objection from Israeli Prime Minister Benjamin Netanyahu. President Joe Biden is set to speak with Netanyahu later today. Meanwhile, Taiwan semiconductor shares are rising about 0.7%. That's after sales at TSMC beat street expectations as the company posted a 39% increase in quarterly revenue. NVIDIA and Apple's main chip maker will disclose full results next Thursday and give investors a deeper look at the staying power of AI-driven growth. And our own Lisa Abramowitz sat down with JP Morgan Chairman and CEO Jamie Dimon in London and asked him if mid-sized banks should be able to merge.
They should be allowed to merge. Their boards of directors should be allowed to make that decision based on what they think is in the best interest of the shareholders. You know, this notion that the government should get involved in every single little bank deal, I think is just wrong.
Dimon also told Lisa he's not planning to run for president. As for this election season, Dimon says he has yet to make a decision on whether to endorse a candidate. That's your Bloomberg Brief. John?
Yahara, thank you. Fantastic exchange between Lisa and Jamie Dimon. Catch the full exchange on Bloomberg.com and on YouTube as well. Up next on the program, pricing in election risk.
It's this period, the weeks before the election, when uncertainty tends to be highest. That leads to higher implied volatility, a little bit of market weakness. But of course, the flip side of that is after the election, that uncertainty moves lower and stocks usually rise higher.
That conversation up next, live from New York. This is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Live from New York City this morning. Good morning. Let's take a snapshot of the price action together and start with the equity market on the S&P 500 at the moment. We're just about unchanged. Decent day of gains in yesterday's session. Though, as we indicated a little bit earlier this morning, the bulk of this, a lot of this came from big tech. The run that we've seen over the last 5 days on a single name, and that single name is NVIDIA. Danny, it's worth going over again. NVIDIA in 5 trading sessions, we're talking about gains of more than 10% just across 5 days.
Yep, and it overtook Microsoft again as the second biggest company in the world. And it comes at a time when so many people have said, look, we're about to enter earnings season, and there's going to be great breadth. Other companies are going to be catching up to big tech. It's the other 493. You can say that as much as you want, but that's not what's happening. As we start to price out some of the Fed cuts, as the economy chugs along, people are going back to the safety of big tech.
And now we have to think about a hurricane and the potential fallout from that hurricane. Anne-Marie went to a single name. Let's bring up Disney and get the latest from Goldman. You mentioned Goldman, Anne-Marie. Hurricanes Ian back in 22, Dorian back in 19, Irma 17, Matthew 17, forced the Disney company to close for 1 to 2 days. And in Irma's instance, multiple cruise itinerary cancellations as well. So Disney World down in Orlando, one to watch maybe in the next several days.
Especially when you see how much Disney now is making money off of things like theme parks. It's really such a big part of their business right now. Goldman, specifically, they said we estimate 150 to 200 million in adverse impact because what is going on with this hurricane in Florida?
So that's the equity picture at the moment. We've talked a lot about Google already this morning. I want to sit on the bond market just for a moment. The 2-year at about 3.95, the 10-year just about unchanged, just north of 4%. The difference between 2s and 10s still positive by around about 6 basis points. This came from Barclays. We've been arguing that a dovish Fed reaction function in the face of economic resilience actually argues for higher rates, which would argue potentially, Danny, for rates to stay above 4% on a 10-year if the economic data continues to come in this fashion.
Well, that was part of the reason that 10-year yields, even before the Fed decision and then after, started to move towards that 4% level. We've been seeing a sell-off in duration for some time, and the assumption that the economy is still strong, and maybe the Fed, after having cut 50, put a floor under it. And then again, you get these people arguing it is time to go in and now buy bonds, that yields finally look good. But you hear like someone from Ray Dalio yesterday who said, I'm sorry, the volatility just makes me not want to be in this market. He, for his part, is short bonds.
The 10-year right now at about 4%. Look out for Fed minutes a little bit later on this afternoon. Under surveillance this morning, pricing in election risk.
The question is uncertainty. And actually, that is the key dynamic that we've seen historically around elections. If you look at every single presidential election year, uncertainty is really the most important thing for stocks. And it's this period, the weeks before the election, when uncertainty tends to be highest. That leads to higher implied volatility, a little bit of market weakness. But of course, the flip side of that is after the election, that uncertainty moves lower and stocks usually rise higher. We expect the S&P to repeat that pattern this year.
So here's the latest. Election day just around the corner, but the outcome could be days, weeks, maybe even months away. The team over at SIBO writing the following. The term structure of VIX futures continues to signal increased uncertainty about the election outcome on November 5th, which dissipates by the Friday after the US election. This implies the market is underpricing the probability of a prolonged contested election. Joining us now to discuss is Rob Hockin of SIBO. Rob, good morning to you.
Morning. Thanks for having me.
How difficult is that, the way things are priced this time around compared to, say, previous elections in 2016?
I think you historically have seen the month leading up until the election a pop in the VIX, roughly call it 10 vol increase in the VIX. And with that, right now the market is pricing in, if you look at the VIX term structure, the October future is really pricing in that volatility premium. It's been there pretty much all summer. Yesterday the October future broke 22, settled right around, just shy of 21.5. And what you see after that in the term structure is really a decrease. So per what you just brought up, the market's really saying, okay, there's a huge uncertainty in the election itself, and then right afterwards, vol goes kind of back to normal, back closer to that long-term historic mean.
In 2020, though, it took days to know what was the outcome. Did you see when basically we were still hanging in the balance, waiting to find out that people were buying in to protect themselves?
Yeah, absolutely. I think this time around, the market's pricing in something different. Us as an exchange, it's, we don't really have an opinion on that. I think it's more, using the VIX. The VIX is a good instrument for this. It's something that uses bids and offers taken from the market. So actually what the market is pricing in, where they're willing to commit capital. And in this situation, the market feels like this one's going to be determined pretty quickly.
The tail risks do seem quite acute at this particular time, not even just the election, but a hurricane and geopolitical concerns. Where do you see those tail risk hedges showing up, if at all?
Oh, they're showing up. It's a great question. They're showing up in really in SPX puts and in VIX calls, with no surprise. On October 4th, if you look at the put call ratio, which is something we like to look at, close to 2.25 puts to every one call traded in SPX. That is much higher than, I would say, the longer-term historical mean, which is around 1.7, 1.8, showing that demand for downside hedges in SPX puts. And all year long, we've had very big volumes in VIX calls, a lot of demand for VIX calls. A lot of that, you could say, is I would say the overall absolute level of the VIX. It's been lower. It's been trading below its long-term historical mean for most of the year. And with that, you have an ability with VIX hedging, with VIX calls, to say the VIX can increase dramatically from, say, 17 to 34 to 35, and you get kind of a bigger bang for your buck on your hedges when it comes to using VIX calls in that type of move.
Earlier in the year, the characteristic, at least of single stock volatility, was protection on the upside, of the right tail being the new left tail. John mentioned that tech, again, is carrying this market. Do you see that demand coming back in, that people, not even just from these geopolitical events, but see further gains and want to be there for that?
Absolutely. I think options volume as a whole is increasing, and a lot of that is due to investors wanting to define their outcome. Wanting to have, reduce volatility in your portfolio and have a better idea of where your portfolio can go and where that outcome can take you. And so we continue to see increases in options usage. I think it's interesting to see the balance between the shorter term expiries, where you're seeing a more balanced 1-to-1 put to call ratio. And that's to say daily events or trying to hedge out shorter term events is much more balanced to the upside, to the downside. And then our longer term exposure is definitely more to those kind of, black swan, tail risk type events where you're seeing that put call ratio and you're seeing more downside trading in SPX.
Rob, appreciate the update. It's good to see you, sir. Thanks for coming in. Rob Hocking there of SIBO. Up next on this program, the second hour of Bloomberg Surveillance just around the corner. We'll catch up with Richard Chilton at Chilton Investment Company. We'll speak to Jessica Taylor of the Cook Political Report, Hugh Van Steenis of Oliver Wyman on the future of asset management and what it means for some of the big banks on Wall Street, and Craig Fugate, the former FEMA administrator under President Obama. Don't miss that. The second hour of Bloomberg Surveillance just around the corner, with equity futures erasing this morning's losses on the S&P 500, just about unchanged. From New York, good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Could there be a more dramatic drawdown? I think that's certainly a higher probability event.
This market lacks anchors, and until we restore some sort of anchor, you're going to have this volatility.
It really looks like more and more parts of the equity market are able to raise profits.
The health of the stock market is going to depend on earnings.
There's plenty of legs to this bull market. There's plenty of drivers for that bull market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with equity futures on the S&P 500 just about unchanged. On the S&P, on the NASDAQ 100 too. On a Russell, we look a little something like this. We're down by almost 0.1%. One single name we keep returning to, it's Alphabet. Google in the pre-market down by about 1%. As we said earlier on this morning, it's the DOJ knocking on the door of Alphabet this morning. Danny, that stock is down by 1%.
It also underscores the difficulty of relying on too few stocks. Yesterday, it was big cap tech that led us on the way up, Alphabet being among them. Here's one of the clear risks going forward. So many people have said any sort of idea that these big tech stocks would be broken up, it's not a reality. You can keep buying them. It's not a risk. The risk needs to really be priced in now.
John, to your point earlier, the fact when you sit down at a computer and you see Bing, you immediately, likely most of you will go to google.com. If you wanted to find out about this antitrust case, you probably Googled it. And this is what the DOJ filing gets into the heart to. Quote, Google controls, and basically what Google does, is indispensable to the lives of all Americans, whether as individuals or as business owners, and the importance of effectively unfettering these markets and restoring competition cannot be overstated. So they're calling for a breakup, but there's other ways also potentially they can do to remedy this case.
When you get this big, when you become this dominant, you attract this kind of attention. Let's tee up NVIDIA. Let's talk about NVIDIA getting even bigger. 5 days of gains, a rally of more than 13%. In that period, Danny, we're talking about adding an additional $390 billion of market cap.
We're back to that old thing of if you check where NVIDIA is, you can probably guess where the market is going. Yesterday, NVIDIA contributed 15 points to the S&P 500's gains. That's a third of the gains yesterday attributable to one stock. We were speaking with Ed Yardeni yesterday, who was worried about valuations in this market. If you worried about them yesterday, you're certainly worried about them today. especially going into an earnings season where the rest of the 490-30 is supposed to be picking up the slack. It's supposed to be widening breadth. We're not seeing it.
That stock is up by another 1.2% in early trading. Your week ahead, your next 24 hours looks a little something like this. Later on this afternoon, some Fed minutes from the Federal Reserve's last meeting. You'll get those at 2 p.m. Eastern Time. Tomorrow morning, the big data point of the week, CPI in the United States of America at 8:30 Eastern Time. Then we're getting closer to this, Danny. Looking forward to it. Friday, earnings from JP Morgan and Wells Fargo.
And to get a read on this economy, because the macro data has been confusing at best. As Mohamed El-Arian put it, this market lacks an anchor. Can the earnings season serve as some sort of anchor? Already we've heard from Pepsi. Those results weren't great, still a value-conscious consumer. We're going to hear from Delta tomorrow. And then, yes, the banks, the credit conditions will be vitally important. And maybe it can serve as a better read, again, as things like jobs data really impacted by some of the bigger events going on in the United States.
A lot to work through for the next several days. Equity futures on the S&P 500 just about unchanged. In the bond market, still holding on to a 4 handle. The 10-year up by almost a basis point of 4.02%. Danny alluded to it just then. The economy, and there's a lot going on in this economy right now. The prospect of Hurricane Milton being a Category 5 storm when it lands on Florida later on this afternoon, this evening into tonight. I think the AccuWeather forecast that we spoke to a little bit earlier on this morning was talking about 2 a.m. Eastern Time being the time for landfall a little bit later.
Yeah, 2 a.m. And then it's not just the landfall, it's the storm surge afterwards. In an area that has already been impacted by Hurricane Helene, you don't have the same natural protection that you maybe did before. What is going to be the impact of having 5.5 million people told to leave a region, of having roads stuck up with these people being unable to get gasoline in their cars? And then you add on the human toll. It could potentially be devastating.
Exactly. If you're trying to get out, can you even get gas in your car? Gas Buddy talking about more than 1 in 5 gas stations right now are out of gasoline. We spoke to an analyst, though, from Moody's, an economist, talking about the fact that this is going to reverberate for a number of jobs reports in the next few months, because it's going to be very challenging to read the economic data coming out of a place like Florida, that 1-2 punch, Jonathan, that no one wanted to see.
This is the lineup for the next 60 minutes on some of these issues. Richard Chilton of the Chilton Investment Company as the DOJ weighs breaking up Google. We'll catch up with Hugh Van Steenis of Oliver Wyman on why private credit could be the Ozempic for big banks, and former FEMA administrator Craig Fugate as Florida braces for Hurricane Milton. We begin this hour with stocks slipping just a touch as the DOJ weighs breaking up Google in a historic antitrust case, putting other big tech companies on alert. Richard Chilton of Chilton Investment Company says in today's market environment, the highest quality companies have been able to strengthen their economic moats and grow their market dominance at the expense of small and mid-sized companies. Richard joins us now for more. Richard, good morning. Welcome to the show.
How are you today?
I'm good. It's good to see you. Let's talk about some of these single names and pick out one. Let's take Google. The threat of getting too big, market dominance becoming a problem, and the DOJ knocking on your door and maybe blocking your advance as a company for years to come. How do you think about that big issue?
Well, I mean, you know, certainly with Google, we could see in Commissioner Khan's the way that she's been holding herself that large tech was on her list, and you know, they're great companies. These are all great companies, and I think that where they're looking at Google is whether or not they used their scale to be able to force feed their search with respect to Apple and others. You know, and certainly that came over in Europe where they got binged for that, and they had to, pun intended, and they had to open it up. It's still the best product out there for search, and so my guess is that when we get the ruling from the government, it's going to be pretty draconian, and we're expecting the stock to go down on that because it's going to be pretty severe. My guess is as they work through the situation, I don't think they're going to break up Google. I think that they'll put remedies in, and you know, I think the stock will recover from that just because the remedies won't be as bad as what is going to be looked at when they first come out.
Going after big tech is really a bipartisan issue. It was the Trump administration that first talked about going after Google and filing that antitrust suit. When you look at what's going on in Washington, especially with big tech, does that make you as an investor want to stay on the sidelines?
Yeah, I mean, I think that, you know, look, there's a lot of these companies are, as I said, really good businesses, but they've had huge runs, and there's a lot of expectations built into them, and their valuations are very full. And you know, there is There has been issues that have been come out there with respect to privacy issues with teens on places like Meta, Facebook, and others, Instagram. And some of these need to be addressed from a societal point of view. And you know, that doesn't mean that they can't continue to grow and serve their audiences. But we do need some safeguards, and I think it's smart that we're doing that. TikTok is one of those, which, you know, is a very, you know, President Trump came out with that, but it's a very big issue because of the data collection that they're doing, and it's falling into the hands. I think it's interesting because in the old days with linear TV, no foreign entity could control more than 20% of any broadcast or media outlet. Period.
Rupert Murdoch became an American citizen.
Exactly, Emery. But what's happened? Have we forgotten that just because it was linear TV? Here you have one of the largest media companies in the world who is influencing the lives of Americans, elections, people, and collecting data. And it's completely owned by a foreign entity. That doesn't make sense.
It feels like we're almost in a new world, and you talk about this in your notes, that you say we're in an era of, quote, creative destruction. What does that mean?
Well, Alfred Schupper, who was an Austrian economist, coined that term, and it's kind of, in a very generic sense, it's the big getting bigger by eating the smaller. And we've been going through that for a very long time. You know, that's why we don't have any buggy whip manufacturers anymore, why we don't ride around in carriages, because we have cars. And it's been moving down that path for a very long time. But the pandemic accelerated that. So think of a very gentle snowball going down and getting bigger, and then all of a sudden getting really big because it hit a steep slope going down. And that's been happening. And it's a really difficult time to be managing small businesses in America, both public and private, in part because they don't have pricing power. They have tough times with sourcing workers. Their pay packages are higher. There's no supply chain that they can really rely on. And as a result, the big are getting bigger, and that's creating opportunities in a whole handful of companies that are going to make them incredible businesses for the next 10 to 20 years. And that dominance is just increasing.
There does seem to be, though, in some of the biggest companies, stress taking form in the way of corporate turnover, of executive turnover. Boeing, one example, having its own idiosyncratic issues, but places like Nike, for example. Is there something unique about today's environment that is pressuring corporate executives in a way that it didn't before?
Well, Danny, you mentioned a very interesting case study with Nike, and you know, Nike is being eaten. You know, and so what companies have to grow and change and evolve and keep up with things, or else they're going to fall victim to AOL and Yahoo, the Yahooism, okay? And that was a perfect example in AOL and Yahoo. Nike has seen in the last 5 years, companies like Hoka reach $2 billion in sales, On reach $2 billion in sales. They are not the preferred, you know, brand anymore, certainly in apparel, which they had the premium edge on, and now, you know, just do it, Nike. I mean, it was really now they're kind of an also-ran in a brand, in a category that has no pricing power. So they got some serious issues, and it was because of the insular nature of their business and their management for a long time. And there are others out there like that. And it's going to take a long time. Starbucks is one that's like that too. And you know, we have a lot of respect for the new CEO of Starbucks. We owned Domino's we owned Domino's for 15 years when he was there and worked his magic. And he's a great CEO, but it's going to take. You can't turn ships like that around on a dime.
It seems like there's been this real concentration for CEOs to understand what's actually happening within the company, within the floor. Home Depot is a great example of this, and I know it's one of your companies in your portfolio too. Yesterday, the story came out that they're telling their employees in the executive and corporate office, you need to do one day on the retail floor. 8 hours once a week, you need to be on the floor. It's a company that's had a difficult period coming out of the pandemic after everyone pulled back from their spending on home decorating and home refurbishing. What do you make of this strategy saying, get back to the people, essentially?
You know, I like that strategy. And when Home Depot was started, everybody had to do their stint. It's kind of funny. Some of the better companies used to do that. I remember when I first started out in this business, I covered consumer and I covered restaurants. This was 1983 when I was working in Alliance Capital. And to cover McDonald's, either as a buy side or a sell side, you had to go to Hamburger U. And you had to spend a day at Hamburger U. And it was pretty hysterical seeing all these, pedigreed Wall Street analysts flipping burgers. But they used to make people put on the orange jacket, the orange vest, and go and work on the floor. I think that's part of a culture, and I think it's really important. You can't be in the retail business without understanding what people want, to buy. And the thing that's interesting about Home Depot, which dovetails into this whole bigger, getting stronger, is when we first bought Home Depot, I've owned Home Depot for forever. But when we first bought it in this last go around, which was January 19th, 2010, it had a TAM, a total addressable market of about $180 billion, and it served the retail do-it-yourself medium. Today, that TAM has expanded to $950 billion, and 52% of their business comes from servicing the pro. And so they're not just what they were, they're now basically like a wholesaler, like of building products to the professional, which gives them a lot more ability because since 2017, they've been increasing their supply chain, they've been bringing in the stocks, and a lot of the smaller local places can't do that. They don't have the merchandise. They can't get it for the price. So it makes that business incredibly attractive going forward.
Richard, thoughtful stuff. It's got to catch up again. Richard Chilton there on the latest situation with corporate America. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Florida's bracing for Hurricane Milton. AccuWeather reporting the Category 5 storm is expected to make landfall around 2 a.m. Eastern tomorrow morning. Milton is packing winds of 160 miles per hour, a speed strong enough to tear homes apart. The Tampa Bay area is also facing a storm surge that could reach as high as 15 feet, which would lead to widespread flooding. This will be the second major hurricane to strike Florida in less than 2 weeks. Meanwhile, Rio Tinto is making its first acquisition deal in Rio Tinto is making its biggest acquisition deal in 17 years. The mining company agreed to buy Arcadium Lithium for $6.7 billion in cash. Rio will pay $5.85 per share of Arcadium. That's a 90% premium to its closing price on October 4th, which is before Rio first confirmed that it had made an approach. And as we mentioned earlier, our own Lisa Abramovic sat down with JP Morgan Chairman and CEO Jamie Dimon in London and asked him if he sees a deterrent for companies to go public.
In the United States, we've made it hard to go public. We've eliminated research on smaller companies. The costs are much higher. The litigation expenses are higher. Filing with the SEC is higher. So I think it would be really incumbent upon us to try to make it easier and cheaper to go public.
Dimon also told Lisa he thinks the Fed was late to raise rates, but they did the right thing by lifting their foot off the gas. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Florida, bracing for disaster.
This storm is expected to make landfall on the Florida Peninsula, the west coast of Florida, sometime late Wednesday evening, maybe early Thursday morning, and really almost every place on the west coast of Florida could get major storm surge.
The latest on Hurricane Milton, up next.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The equity market looks a little something like this. We're down by 0.06%. In the bond market, you're still in and around 4% on a 10-year. In the commodity market, we'll pull back once more. We're down by 0.8%. WTI, 72.96. Under surveillance this morning, Florida, bracing for disaster.
This storm is expected to make landfall on the Florida Peninsula, the west coast of Florida, sometime late Wednesday evening, maybe early Thursday morning. I know that there's a lot of folks who have evacuated, who are in those areas, and you absolutely could get whacked with really serious storm surge. Really, almost every place on the west coast of Florida could get major storm surge.
So here's the latest this morning. More than 5 million people being urged to evacuate Florida's Gulf Coast, with Hurricane Milton expected to make landfall as soon as this evening. Governor Ron DeSantis declaring a state of emergency in 51 counties and holding calls with President Biden on preparations for the storm. Joining us now is Jessica Taylor of the Cook Political Report. Jessica, let's talk about the politics, the electoral politics of all of this. It's not just Florida, it's parts of Georgia. We've seen western parts of North Carolina become absolutely devastated, eastern parts of Tennessee as well. When you look at some of the races that you cover, and you acknowledge the fact that we're talking about 51 counties in a state of emergency across Florida, how many of these races become very, very difficult to gauge now, given what's playing out following Hurricane Helene and Hurricane Milton?
I mean, I think in the past few weeks, it's been North Carolina, because that's such a focus at the Electoral College level, and those areas of western North Carolina, with the exception of just Asheville, which is very Democratic, but overall, those very rural counties are incredibly Republican. And now it becomes a question of, are people able to get absentee ballots? Do they have their IDs? Do they have to get replacements? Are there going to be mobile voting shelters? And, for a lot of people, voting may not be atop their mind when you're worried about, losing your home or different things, and just, finding basic necessities. So I think polling in North Carolina, I think for these last few weeks is just going to be difficult, if not impossible, to get that. But like I said, we just don't know how that's going to affect turnout. But given those are very Republican areas, that certainly, could hurt Trump in that area. And then, you look at just the politics of the misinformation that we're seeing spread, blame that even Republicans in the state there, the Senator Tom Tillis has worked to refute that, this FEMA money that is coming in is separate than money from FEMA that was meant to address the border crisis. And then, Georgia, how does that affect it? That's the state that's probably been slightly trending in Trump's favor. And then, in Florida, there is a key Senate race there. Florida is no longer the presidential swing state it once was. But, I think the focus right now rightly is on helping these people in the path of the storm, ones that have already been affected by Helene. And then I think in the coming weeks and days, sort of in the aftermath, I think we'll be addressing how this affects voting and what needs to be done.
Jessica, you make a good point. When it comes to North Carolina, it's really about the Electoral College and the top of the ticket. When it comes to Florida, though, that Senate race could be really impactful. What are you looking at with the Cook Political Report into how much that is leaning towards incumbent Rick Scott's win?
I think Florida is still a difficult lift for Democrats. That, we still rate this race as likely Republican. There's some money that, could have been pouring more into it. But I think as Democrats need another seat, especially as Montana moves out of their direction to keep the Senate majority, Texas is becoming the more likely pickup. We're seeing more money pour into that other than in Florida. And then right now, if Florida, state like Florida, it's about communication, it's about getting your message out. And people aren't focused on political messages right now. So I think that's also made it more difficult. But I still see Florida as a harder lift for Democrats, certainly, when it comes to this.
I want to get your latest on this call in Wisconsin. You say now the Senate shifts from lean Democrat to toss-up. Why? Mm-hmm. This is an incumbent seat.
Yeah, so we've seen some of these Democrats outpolling Kamala Harris. Tammy Baldwin there, the two-term incumbent, was ahead of her. I think Wisconsin is probably as close to an evenly divided state as we have. In our most recent swing state polling that we did at the Cook Political Report in partnership with BSG and GS Strategies, we found this at a 2-point race, 49 to 47%, Baldwin having a very narrow lead over her Republican challenger, Eric Hovde. He's a wealthy businessman, has put about $20 million of his own money into the race. The spending, which had been favoring Democrats, is now more at parity. Internal polls from both Republicans and Democrats mirror our own polls that this is a margin of error race. And so we've shifted this rating. I still think Montana and Ohio are the most likeliest Republican pickups in that order. But then I think it becomes a question of sort of these next blue wall states, and Michigan, but increasingly Wisconsin, we see just becoming a much tighter battleground. And I think, again, that's just a function of that Republican voters are coming home. In our poll, we saw Hovde have an 11-point swing among independents toward him. And so I think just, the last Senate race that we had in Wisconsin in 2022 was decided by 1 point. So these are just very, very close elections.
Jessica, your polling still shows Trump holding a sizable lead when it comes to who do you trust with the economy, but you note that the August advantage he had over handling inflation essentially was wiped out. What do you think changed?
I think that Harris is trying to communicate more on this, separate herself from the Biden administration at times, but talk about affordability and different things. And I also think that, Trump's emphasis on tying her to Bidenomics hasn't necessarily worked. And then I also think as we look at some of the economic indicators with gas prices going down, we'll see where that remains for the rest of the month, of course. I think that's one of the biggest consumer confidence indicators that we have, just because as you're driving around, you're very cognizant of what the gas price is and different things. And then with the with interest rates going down as well, I think food prices still remain very high. But I think that Harris has come out in many of these regards and portrayed herself as competent on this. So yes, on inflation, that was a very noteworthy number. Overall in the economy, Trump still has a more narrow edge. Immigration, though, is the big issue where he still has the biggest edge over Harris, though that's also increasingly tightened. But when it comes to issues of democracy, on abortion, that's where Harris has the biggest lead over Trump.
Jessica, always a clinic. It's good to hear from you again. Jessica Taylor there of the Cook Political Report on some of these races across the nation. The most overused phrase of the last 2 months: things are finally balanced. It's a close race. How many times have we all heard that? It's getting closer. It's getting harder and harder to call.
What struck me, though, yesterday on The View was Kamala Harris's answer to what distinguishes her from Biden. There's not a single thing that comes to mind in terms of, what has been impactful from the Biden administration. And Republicans really harped on that.
It's on repeat on social media yesterday. Coming up on this program, Hugh Van Steenis of Oliver Wyman on the state of the banking sector ahead of earnings due later this week. From New York, this is Bloomberg.
down to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equities, a little bit of a struggle on the screen this morning. We're down by almost 1/10% on the S&P 500. Yesterday, a decent day of gains on the S&P, driven by some major moves in big tech. We've been talking about it all morning. This 5-day run through yesterday on NVIDIA, gains of 13% plus. We're talking about $390 billion of market cap added to a single name in 5 sessions. We're up another 1.26%. this morning in the pre-market. That's the equity screen. Switch up the board, turn the page and get to the bond market story. The 2-year at the moment, 395, just off 4%. The 10-year, that move sticks. How many times have you heard this over the last few days? We're in the buy zone. 4% to 425. You've got another chance of getting another bite of a 4% yield in America. Take it, Danny. That's P. Jim's argument.
Do you want to buy ahead of a CPI report, though, which seems to have taken on new importance? The idea that the labor market is sound, the economy not only is chugging along, it is quite strong, 3.2% on the Atlanta Now GDP tracker. If inflation is a worry again, can you really buy at 4%? If it could be more than 4%, given tomorrow's data.
CPI, 8:30 Eastern tomorrow morning. Let's turn the page and get into the commodity market. Here's the picture of things right now on Brent crude and WTI. Brent crude was on a 5-day rally. 5-day winning streak. We snapped that yesterday. We broke it with the biggest one-day slide since early September. Almost the biggest one-day drop going back to 2022.
I still maintain this has to do with what happened in China. Basically, you thought China was going to do more in terms of stimulus. They didn't. They said we'll meet our growth forecast, but a lot of people are concerned that that's not going to happen. So this was really the demand side pulling back. But the fog still maintains over the Middle East on what is going to happen, and potentially we will see more money to the upside in the oil market because of that risk premium. Pierre Andron yesterday getting back into this trade that he exited over the summer, and he thinks about $10 to $15 potentially from 80 could be on Brent.
Pierre Andron on copper. Still thinking about what he said on copper. He said that we could see a multiple on copper, 3-4 times where we are in 5 years. I found that amazing.
Yeah, and I mean, so much of this is kind of like the long-term transition of reasons you could be bearish of maybe China, the economic stimulus isn't going to be as good, all of this. But he really talks about the transition is happening and these longer-term trends that allows copper to make a move like that. Again, when that had kind of fallen out from the floor, back in concentration again for him.
Copper down 0.6% on the screen right now. Likewise on crude, WTI $73, Brent crude at about 77. Under surveillance this morning, Hurricane Milton churning towards Florida's Gulf Coast as a life-threatening Category 5 storm. It's expected to make landfall tonight near Tampa Bay, just 2 weeks after Hurricane Helene devastated many areas.
This is devastating, and basically everyone is just bracing for the impact right now. And now this was, Jonathan, as you've been calling it, the 1-2 punch no one wanted. I spoke to Governor DeSantis's office. They said that this was the black swan event that they always worried about, and it's actually happening. He's basically just hobbled up now in their emergency center, fielding calls, talking to people like the President of the United States. Yesterday, President Joe Biden confirmed what already the DeSantis office told me, which was the president gave him his personal number. Call me directly if you need more, because they are so concerned about the impact of this hurricane.
And we can't forget that in North Carolina, there are still people without food, cell phone service, basic supplies. there's still people there who are in need at a time when FEMA is quite stretched. Mayorkas, the Secretary of Homeland Security, continues to emphasize we have enough money for these short-term things, but otherwise, we're in the trouble for the long haul. Him and Biden both have called for Congress to come back and approve some sort of longer-term budget, saying we don't need Band-Aids. But it's putting out multiple fires. It's another hurricane after so many regions are already facing devastation.
The former FEMA administrator on this program in about 10 minutes' time, so look out for that conversation. Here's the latest in the Middle East. Israeli Prime Minister Benjamin Netanyahu is set to speak with President Biden later today to outline the nation's plan for retaliation against Iran. The two leaders haven't spoken since August. Today's call coming after Israel's defense chief abruptly cancelled a trip to Washington.
It also comes, today's call, after these remarks that President Biden allegedly said about Bibi Netanyahu were released to the press through this Bob Woodward book. And I'm not going to quote them here because, quite frankly, they're not acceptable for a morning show. But basically saying that Netanyahu is a bad guy. Reading the tea leaves of this, if you're the U.S. administration, you want to slow down what Israel is doing, you would send your defense chief over to the United States, because there's no way that they're going to launch a retaliation attack on Iran when your defense chief is in Washington and not in Jerusalem. So what this says to me is potentially it is more imminent now than I would have thought at the start of the week.
So we just sit here waiting as we have been for the last 2 weeks or so. Here's the latest on China. Put this one in the diary. China's finance minister planning to announce on Saturday fresh moves to further strengthen fiscal policy. China's State Council Information Office confirming the upcoming briefing as the country's world-beating stock rally loses steam. The CSI 300 getting hammered overnight, down by 7%.
For what it's worth, this is the body that would announce more stimulus instead of like we heard from earlier this week. But I think you can even see from the market that this idea, everyone expecting a massive package of stimulus, has kind of fallen by the wayside. Volatility makes you think twice about investing in Chinese markets. And just to put a fine bow on it, expectation setting for an opaque market is so difficult. For whatever these policymakers are trying to do, it is almost impossible to really discern it just because it's a difficult market to read, and it's almost intentionally so. They've made it that way.
Are you tuning in for the briefing on Saturday?
I don't know if we'll get much from it. Hey, Nomura says that they should, everyone should be calm, so that's a reason I can stay home on Saturday and not pay attention.
It's not just that he's going to be briefing the press. He will also be taking questions. So I hope those reporters go in with some hard-hitting questions.
Look out for that this weekend. Do you get hard-hitting press questions in China press briefings? Does that happen?
Likely not, but tune in.
Okay, let's turn to the financials. Big bank earnings kicking off with JP Morgan and Wells Fargo on Friday, followed by Citi and Bank of America next week. Hugh Van Steenis of Oliver Wyman writing the dynamics between traditional banking and private lending might be changing, saying this: what we are seeing is the retrenching of the banking system, where banks parcel the riskiest slice to private credit, providing less risky lending themselves. Private credit could be the Ozempic to help banks on yet another diet. I'm pleased to say that Hugh's with us in New York. Hugh, it's good to see you again.
Lovely to see you too. Thanks for having me.
Thanks for joining us. Let's talk about some deals that came up in the last week. The one that jumped out for me and for many of us, Citi and the partnership with Apollo on $25 billion worth of deals. What does that mean to you? And do you think that's kind of the blueprint for how these companies will work with each other in the future?
Look, I think this is one of the deals which sort of does change the conversation. We've seen 14 partnerships between private credit and banks in the last 12 months, up from just 2 the year before. And I think it's because the banks are realizing that they need to shed risk. Part of it is because they're anticipating Basel Endgame. Now, even if it's not going to be anywhere near as bad as they first thought, they still need to diet. And so what they're trying to do is now slice up their balance sheet and put the riskier pieces out. So in the case of the Citi deal, it's to lay off some of the non-investment grade risk. But I actually think some of the other interesting deals are ones where actually private credit is also replacing investment grade. And I think that's one of the most interesting things in private credit at the moment. By having insurance assets, as we were chatting about, they're lowering their cost of capital, and they can then become much more competitive for IG assets.
When you say the riskiest parts of credit, do you mean the most profitable parts of the bank business model are going to private markets? Is that another way of putting it?
So it can be a little bit more subtle than that. So it depends on the type of trade. So let's take, the US has now allowed synthetic risk transfer, so people can actually slice up their sheet. They're almost like do your bell curve. They're slicing off the bottom couple of percent. So the riskier piece, which means they don't have to hold as much capital. So what they're doing is much more an optimization trade than simply just shedding risk. But yeah, I mean, let's be clear. You know, in life, people either play to win or play not to lose. The largest banks are saying, we can now do deals with private credit. We can actually write even more loans, take a bigger ticket, do more share of wallet, but we need to lay that off. The ones who are playing not to lose are really worried because they're worried that private credit will actually encroach on their sheet and they'll become, as one CEO told me, dumb pipes.
Well, with all of those worries, as private credit just gets bigger, there's always going to be someone out there who says there's a risk, there's a black box, more debt there. I thought it was interesting, the SEC's top enforcer early in the year made an argument, not of that, but just saying there's just too much concentration, that it's not necessarily that it's a black box, but it's just too few people chasing and owning these assets. Apollo talking to John about doubling in size over the next 5 years. Is there a sense that this is becoming an industry too big to fail?
No, look, I think the systemic risks that people worry about seem to be overplayed. I mean, look, as I think you had a great interview with Mark last week, they're a small business in the context of asset management. You've got BlackRock and others that are, north of 10 trillion. You've got PIMCO as a couple of trillion. So I think in the context there, I think that's not the case. And also remember, you're not getting counterparty risk to Blackstone or Apollo. You're getting counterparty risk to the asset they run. So what you really want to make sure is, are they thoughtful about their credit decisions? Have they scrubbed the sheets down? And for that, you need investment research. And just like your program, you need, credit is a bit different. You can't do it with sort of 5 guys in Westchester. You need a few more people because you need to originate the assets. And actually, I think, therefore, scale actually helps them originate assets. I mean, I don't know how you see it, but I see that the big firms are really breaking ahead. So if you look at private credit overall, asset raising this year is probably about the same as 2019. But the top 6 firms just got 22% new money in the 12 months to June versus the traditional firms just 1%. I mean, they're really breaking ahead.
Because after the pandemic, it was this kind of free-for-all feeling of like everyone's trying to start a private credit firm. Is that just done? Is it the big are going to get bigger? If you're a small firm or even want to start a firm, it's just not possible in today's environment.
Oh, look, from my conversations, and also with the traditional firms who are trying to, let's be clear, get into this, there's a lot of firms who've got the for sale sign up. Not at the top end, but there's ones who go, well, they either need to source assets or they need to originate assets, both of which are tricky because of the dynamics at the moment. So no, I think there's a hollowing out of the middle.
So there's no peak in private credit. How much more does it really have room to grow?
Well, look, there was this cheeky comment about the golden period. In 2023, the banks were on the back foot. As last time I was here, we chatted about that private credit took 90% share of LBO financing in 2023. The banks are back in business. They've taken back about half the share. But what's really interesting is different banks. I mean, it's the really big ones who are squeezing. No, I think there's more runways. I mean, the way I think about it is that we've had wave after wave after wave of disintermediation in US banks. I mean, bank lending as a share of the economy peaked in 1973. It's a long while ago. And so I think the next wave is around asset-backed lending, about real estate, and a bit of infrastructure. And so actually it's more about moving into slightly different asset classes rather than just LBOs and direct lending.
Let's spend some time on that. Let's talk about the future of banking. To hear what you just said, that bank lending as a percentage of the overall economy peaked back in the 70s might be news to a lot of people. We had a guest come on the program a few months ago, and I often get this guest from KBW to go over the same stat again and again and again. Just how many banks are actually in the mortgage lending business, how they've retrenched over the last 10 years. If banks aren't in the money lending business anymore, what are they in? What are they doing? What's the future of bank lending?
Well, look, there's a huge variety. I mean, let's be clear, it's the larger one. And at the end of the day, banking was there to try and help payments and store your money. They're still doing that, obviously, and the crypto boom and has not meant that people are not moving their money out there. So I still think there's a lot of payments and managing your things. So security services, prime brokerage and so forth, there's still a fair degree of lending for investment grade assets. So, let's be clear, but I think, let's say, if you're looking at the banks, the bottom line is, if you're lower margin, you need more scale. So I think it's really interesting whether it's the UniCredit deal announced, whether it's been the flurry of US deals in the 2 years before. It's about how do you get more scale? And that's the challenge I think my conversations with banks are having about.
How difficult is it to get scale in Europe?
Oh,
you brought up that
brutal.
deal. How hard is that going to be?
Yeah, I mean, it's such a... Well, look, I wish Andrea best of luck on this, but it's tough. There's been, one cross-border deal in the last 5 years? I mean, it's really been
What's difficult about it? Is it a cultural thing? What is it? What's holding it up?
All sorts of things. A lot of it's... So think about it. If at the end of the day, the purpose of a bank is to hold deposits and help you pay, then you want a great deposit guarantee scheme. And let's be clear, even here, basically you had to sort of verbally guarantee all deposits, 18 months ago. So we have a fragmented quilt of deposit guarantee schemes. In fact, in Germany, you have 3 different schemes. You don't even have one for the country. So you can't get cross-border. But, on the positive side, Just take the UK, where I live. We've got 3 deals at the moment, which are live, of in-market consolidation. So it's happening. It's just probably not on your show because it's not sort of absolutely top of the news list.
One of the other things that the banks are trying to do to keep up is in their asset management divisions, have their own private credit. Goldman is a great example of this, a monster $20 billion fundraise for them. It is more competition in the industry. What does that mean in terms of covenants getting lighter, of giving more favorable terms, of maybe some of that risk of too generous of terms creeping into deals?
Oh, look, everyone wants to get into private assets one way or another with partnerships. And one stat we put out in a report yesterday, which comes back to conversations we've had, is if you take all the listed asset managers in Canada and US, 64% of the value is now the alternatives. Dial it back to 2010, it was 4%. I mean, they are dominating, and so it's kind of, if you can't beat them, join them. And so actually, I don't think you've had on much, but I think one of the most interesting discussions is not so much is X buying Y, but the partnerships. So whether it's Partners Group with BlackRock, or KKR with Capital International, or Apollo with State Street, these kind of like, maybe not all of them will work, but at the investment frontier is these hybrid products and trying to work out which one's going to work to get into sort of a mass affluent hand. And so if you go back to what the traditional firms are doing, they're all thinking, who do I partner up with if I can't do it myself?
Hugh, you're the best. It's always good to catch up with you, sir. Thanks for your time.
Thanks for having me on.
Hugh Van Steenis there of Oliver Wyman. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Alphabet shares are falling about 1% in the pre-market as the U.S. Justice Department considers breaking up Google. The agency saying in a court filing it's considering options to mitigate the tech giant's dominance in search. The judge could also order Google to provide access to the data it uses to build its search results and artificial intelligence products. Google has already said it plans to appeal the ruling. Meanwhile, Bloomberg reporting Couche-Tard sent Seven & I a fresh offer worth $47 billion. The Canadian company is still trying to take over the Japanese retailer after its initial bid was rejected, but no new negotiations have taken place. The latest offer represents a 20% premium from the prior offer and Seven & I's closing price yesterday. Meanwhile, Boeing shares are falling in the pre-market. The company withdrew its contract offer to workers as talks with the International Association of Machinists and Aerospace Workers Union broke down. Both Boeing and the union blaming each other for the impasse. S&P Global Ratings warned it may cut Boeing's credit rating to junk as the strike nears the 1-month mark and its cash struggles pile up. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Hurricane Milton closing in.
It could be catastrophic, especially around the Tampa Bay area, down south to around Venice, where we could see as much as 15 to 20 feet of storm surge just south of where the storm makes landfall.
That conversation up next, live from New York City. You're watching Bloomberg TV.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old. There's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks just about unchanged on the S&P 500. We're negative by 0.05%. In the bond market, a lift. Yields up by 2 basis points, 4.03%. Under surveillance this morning, Hurricane Milton closing in.
It could be catastrophic, especially around the Tampa Bay area, down south to around Venice, where we could see as much as 15 to 20 feet of storm surge just south of where the storm makes landfall. You could have multiple high tide cycles of storm surge coming in. And then, since we had Helene, a lot of these bays and inlets, the barrier islands, have been significantly weakened by Helene.
So here's the latest. FEMA bracing for Milton's landfall. Already stretched thin following Hurricane Helene, the agency is preparing for a $3 billion deficit by February, but the government says it has the resources to meet immediate needs. The former FEMA administrator, Craig Fugate, joins us now. He led the agency under the Obama administration. Craig, thank you for giving us your time this morning. We recall also some of the work that you did with Governor Jeb Bush back in the early 2000s, and maybe we can start the conversation there. Of the hurricane seasons that you oversaw in 2004, 5, 6, when you think back to that period, what's different about the hurricane seasons now that we have to confront in Florida?
Well, I think we're just seeing rapid intensification that we haven't seen before in history. So when you look at going back just 10 years, how many storms went from a tropical system to a Category 5 hurricane in less than a couple of days? And so, you know, I think we're having to just get ready for these more intense hurricanes as they're approaching and maybe not have the lead time. The good thing about Milton is there's been a lot of time to get ready. In fact, many people started evacuating as early as Sunday. So this is a little bit different than a storm that just popped up. They had time to get ready, but it will not reduce the impacts.
Craig, let's talk about the FEMA response. Are they prepared?
Yeah, I get this question a lot. And as bad as Helene was, FEMA has a lot more resources, a lot more capability. And they're not going to have to stop the response in Hurricane Helene. That's, I think, a big concern for people in that area, that while the national media is focused now on what Milton's about to do, FEMA is still working and supporting the governors in the states that have already been hit. And again, the priority in any of these disasters will be always life-saving, life-sustaining, and getting communities stabilized to set the stage for long-term recovery.
FEMA recently said, though, that they have only 9% left of their personnel reserves. That's about 1,200 people. Where do they look then in terms of getting the bodies they need to go to these areas that are going to be hit?
Well, those numbers really refer to staffing required for long-term recovery. The initial response teams reset between disasters. FEMA has a lot of capability to reprioritize their resources, as well as deploy people from the headquarters. We did this in Superstorm Sandy. If FEMA needs to, and given the size and impact of what Milton looks to do, I would imagine there's going to be a lot of people redeployed across the nation to support the state of Florida.
Is the current funding enough, or do you think Congress is going to be forced back into session and get off the campaign trails?
Well, right now, FEMA does have money to do the initial response and provide support to the survivors. I think the bigger question is going to be the level of funding required for long-term recovery, the permanent work, and that's not just going to be FEMA. There'll be a lot of federal agencies that will need additional funding to support the recoveries from these previous storms and disasters, as well as what we're about to see with Hurricane Milton.
And it's not even just those storms, Craig. Before it was wildfires out west that also required FEMA money. So you get to this point, as John mentioned, a $3 billion deficit. Does there need to be a structural change with FEMA and its funding to ensure that it can continue to deal with successive climate issues?
Well, this was a situation we actually faced it in the Obama administration, and then Speaker Ryan and at that time OMB Director Jack Lew had come up with a way to increase FEMA's funding, but it was always based upon the past storms, the past disasters. So the problem is we get bigger and more intense disasters with little break between them. We really need to look at a funding mechanism going forward. But I think it's critical we understand this is your federal tax dollars. This is increasing cost to the budget that does not seem to be slowing down. It's growing rapidly, and it's far beyond just what FEMA programs are being taxed with. So for the federal taxpayer, we're seeing a tremendous transfer of risk to the taxpayer, where previously insurance covered this. And as the insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts, we're seeing this transfer of risk to the taxpayer. And that's going to grow, and I don't know if we have answers for that yet.
What does that mean, Craig, for when these areas get rebuilt that are still under risk? A place like Tampa also had impact from Helene, now again Milton. When government agencies, when FEMA, when others go in to rebuild these areas, does it need to look different this time because they are under constant threat?
The answer is yes, and FEMA has for a long time been focused on rebuilding better, not just putting things back. But the challenge is we're going to have to not only just put it back better, we're going to have to build it for the future risk. And that isn't going to be inexpensive. The other problem I see is that we're going to increasingly see a transfer of risk to government-run programs like the Citizens Insurance Program in Florida, because commercial insurance is finding it extremely difficult to be able to stay in these markets where it's an affordable product given their extreme exposures.
The conversation we had earlier this morning, just devastating. Craig, appreciate your time this morning. Thank you, sir. Craig Fugate there, the former FEMA administrator. Look, it's easier, relatively speaking, to protect vulnerable parts of the country that have to confront issues like this one. What's been difficult about the last month or so is the damage done by Hurricane Helene in parts where you would think were untouchable, to the kind of pictures that we saw over the last few weeks.
And it's in these really rural areas, like in North Carolina, that it's difficult to get resources out to, that it's difficult to restore them with internet, let alone basic services. And this is why you get these calls of more needs to happen with FEMA. They need more resources because this is only going to continue to happen.
Coming up next on this program, in the third hour of Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to Geetha Raghunathan of Bloomberg Intelligence on what it means for the Walt Disney Company. Tiffany Wilding of PIMCO looking ahead to CPI in America tomorrow morning. And we'll catch up with Amanda Lynham of BlackRock. Your equity market just about unchanged on the S&P 500. From New York, this is Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
To think that we could slip into a soft landing or a potentially harder landing is not unreasonable.
We look at it as a soft landing as we're already in the midst of it.
The problem with soft landing is it sort of would suggest that things have stopped.
It might not be landing at all and actually seeing the plane turning back up.
The economy is fundamentally sound, so it can absorb shocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This narrative so far this year just going back and forth, back and forth, back and forth. Ian Lingen of BMO with this to say, it is not difficult to envision a more modest round of job gains. Once again, undermining the narrative of a resilient employment landscape, going on to say, when combined with this week's inflation series, investors should be wary of yet another swing in the pendulum of policy sentiment. Equity futures right now in the S&P 500 look a little something like this. 90 minutes out from the opening bout, down 0.1% on the S&P. On the Nasdaq 100, we're down by 0.2%. Going into tomorrow, 8:30 Eastern Time. CPI, the main event for the data so far this week. Before we get to CPI 8:30 tomorrow, some Fed minutes. A little bit later this afternoon, still some queries about what happened to that meeting. Was it Chairman Powell just forcing everyone to go 50?
It will be interesting to see if the Fed minutes reflect any of that, but I'm also interested to see how it's kind of massaged. We know editors can kind of change what's put in the minutes, and considering we've had this jobs report, are they going to be changed to look in a more hawkish light? Are we about to see a discussion that basically takes 50 off the table from here on out and really broadcasts something that says the economy is strong, we don't need to cut as forcefully, and again, you get a hawkish narrative that comes back in and maybe yields go even higher?
I think Williams almost basically said it's going to be 25 from here on out. I'm actually interested in the minutes, even though they're boring and they're backward looking. How many individuals on that committee actually maybe preferred 25 and didn't go with it because they got this pressure from Powell himself, which many people have been speculating because of what happened in terms of potentially the leak or non-leak to the Wall Street Journal and the Financial Times?
Very few of them willing to sort of acknowledge that openly. in public, at least so far in the Fed speak that we've seen. A couple of names to look at in the pre-market. One is Alphabet. It's down by about 1 full percentage point. We've talked about the DOJ's concerns with that particular company. Another stock to watch on a 5-day winning streak coming into today was Nvidia. Nvidia's up by another 0.7% in the pre-market. So the run continues. Look out for that name going into the opening bell a little bit later. Coming up this hour, here's the lineup for you. We'll catch up with Cameron Dawson of New Edge Wealth as tech whiplash hits markets. Geetha Raghunathan of Bloomberg Intelligence on Hurricane Milton's impact on Disney. And Tiffany Wilding of PIMCO ahead of this week's inflation data. We begin this hour with tech stocks whiplashing global markets as traders attempt to look ahead to Thursday's inflation data. Cameron Dawson of New Edge Wealth saying we would not be surprised to see continued volatility in the near term as risk assets are going into this historically high volatility month priced for perfection. The volatility is unlikely to be cataclysmic given the backdrop of strong economic growth and a shift to more supportive monetary policy. With a very long word, Cameron Dawson joins us now for more. Easy to write than say out loud, Cameron. Thanks for that.
I put it in just for you.
Thank you very much. Let's talk about this run we've seen in some of these individual names. Nvidia's had a massive run, 5 days of gains. And for some people, they're reflecting on the first half of this year where we had this big boost in inflation, turned out to be a bit of a head fake. We started to think about high rates for longer and tech stocks really started to perform. Are we reaching for that playbook all over again?
It is interesting to see the equal weight S&P 500, which has been doing better over the last couple of months, start to roll over on a relative basis, which just suggests that maybe there's this narrowness creeping back into the market. And you see it within the tech sector itself. Look at NVIDIA being strong, driving semiconductors, but flip the page to software. Microsoft is breaking down. It's now below its 200-day moving average. So even within the all-great tech sector, there are pockets of weakness being held up by just a couple of names.
Is this all about rate cut expectations? Is that in the driving seat or is this something else?
We think it's the confluence of everything. If you take a step back and appreciate the fact that you have strong economic growth, look at Atlanta Fed GDP now at 3.2%, supported by fiscal deficits as if we're in a crisis, now with the bond market pricing in the largest non-recessionary cutting cycle in 40 years, what is rate or what are risk assets not to like? And we think that's why you see credit spreads so tight. The BAA credit spread is now 100 basis points, nearly at the lows that we saw in 2021. Equity valuations 21.5 times. That's at nearly the highs we saw in 2021. So these markets are priced for perfection, but that's because the backdrop is quite nearly perfect. The question is, can it last and where does it go from here?
Does earnings season help with expectations of under 5% growth year over year? That's relative to what we've seen before, kind of a low bar.
It is a low bar because you've also seen those estimates get trimmed going into this earnings season, so maybe we can jump over this lowered bar. The thing that's interesting is over the last 2 months, you've actually seen 2025 estimates get trimmed as well. We think that's why markets have stalled out over the last couple of months. They've been relatively flat. So you do need to see earnings estimates continue to rise, we think, in order to support the market. The one thing that has been the key underlying support for this market since the beginning of 2022 is rising 12-month forward earnings estimates. That is absolutely critical to maintain.
And you've seen that in 72% of the companies, that's according to Bank of America, are expected to grow their EPS. That's some good breadth. But as John was just describing, the market doesn't have breadth at this very moment. Do you expect that to change?
It's certainly the hope of a lot of people. And if you look into next year's earnings estimates for 2025, the market has priced in the Mag 7 decelerating materially and the rest of the market accelerating in their earnings growth. But in a way that actually creates a high bar for the rest of the market to deliver because you have these big accelerations in earnings growth, which are already priced in and forecasted.
So the banks report on Friday. And we're all reflecting on what we heard maybe 2 weeks ago when we heard from Ally Financial warn about credit risk. And we heard from Dan Pinto of JP Morgan, who talked about lower interest rates maybe weighing on net interest income. What do you think is going to be the standout theme for this reporting season for some of the banks, both big and small?
I think it all comes back to the credit risk question, which is the underlying question that we've all been asking. Is the economic data overstating the strength of this economy? And the message from the banks will be important because they'll give us a notion about small businesses, they'll give us a notion about consumers. And if we continue to see credit risks bubble up, look look at default rates within consumers, that's what Ally was flagging back a couple of weeks ago. If you continue to see that, it would question some of this headline data necessarily not being as strong as maybe it looks on the surface.
In the weeds a little bit, Jack Caffrey at JP Morgan mentioned this yesterday. It's very unusual to see defaults on auto loans. If you go back to GFC, I remember all the stories we'd tell. The car was the last thing. It was the one thing you held on to. You always made that payment. What could that be about?
It's partially a function of the price increases that we saw coming out of the pandemic. It's partially a function of people reaching for cars coming out of the pandemic. But it also likely reflects the true K-shaped economy. It's usually the lower income consumer that's more likely to finance their cars and have floating rate debt overall with credit cards. We do know that the low income consumer is under pressure. And the one thing that is keeping them above water is this jobs market. It's pretty incredible that you're seeing this huge uptick in defaults with a relatively robust jobs market. Look at where the unemployment rate is. If that goes up any higher, this could actually have defaults in that cohort of consumers that would be in line with the GFC, even though consensus seems to be that we're not going to have a consumer-led kind of recession this cycle. So I think it is incredibly unique, but it is certainly something that catches our eye that makes us question the data.
That is one of those things, again, just out of line with an economy that's been driven by consumer spending. You also see it in some of these companies. In just the past month, Pepsi, Constellation, Nike, FedEx, RH, Hormel, Dollar Tree, Lululemon have all cut their sales or earnings. Again, just in the past month. Is there a sector, because this has continued to be a problem for this equity market, of staples, of packaged food companies that you just can't buy until we figure out what's happening with the consumer?
I think it's all a reflection of this fading pricing power, and that comes squarely to head with what we're seeing within forecasts for earnings, because earnings are forecasted to actually accelerate next year on the revenue line. If you see fading pricing power, companies effectively saying, we want to raise prices, but consumers are pushing back because they can't take it anymore, that suggests that you'll actually see a deceleration in revenue next year, which is certainly not what's being priced in.
Does that cap just how bullish you can be on an overall equity market, which otherwise has good fundamental growth in the economy behind it?
We don't think it would be the end of the world or a too reaching of a base case to expect relatively flat returns in 2025. It's not enough to say, get out of your equities and run for the hills. It's just to appreciate that if that 12-month forward earnings number starts to flatline, it's likely that returns flatline. It looks a lot more like a year like 2015 or 2018, where the market chops sideways, and the good news in that is it effectively allowed you to grow into very fulsome valuation multiples, which is where we are today.
Cameron, I hate to be the Debbie Downer, but what if tariff man comes back? What if forward earnings actually look like?
Yeah,
for these companies?
We didn't necessarily see it impact company earnings in a material way in 2018 because it was far more pocketed. If we have broad tariffs, though, this is certainly something that could challenge the earnings picture because we do know it's effectively a regressive tax. We do know it does lower consumption. It's less of an inflation risk and more of the fact that it would dampen consumption, which then, of course, would cause you to question earnings estimates, and that would be a source of volatility for equities.
I meant to the Debbie Downer on the earnings estimates. Do you think companies are going to have to focus on this in this quarter because it is just around the block in terms of what this election is going to look like?
We've already been hearing from companies over the last, let's call it 3-4 months, that they've been delaying some capital spending, they've been delaying some hiring decisions because of election uncertainty. So certainly that is something that's weighing on their mind, whether or not they're going to absolutely make changes because of the election going into this earnings season. They'll probably say, we have to wait and see.
Think about how wide the range is for 2025. A sweep for either side. We could have a corporate tax rate of, what, 28% on the one side and 15% on the other with conditions. What does that look like for you? Just how wide is the range for 2025?
Completely massive. And I think that what we have to appreciate is that both sides, what they have in common is that they're talking about higher deficit spending and growth dampening policies. So on one side, you get growth dampening from tariffs and potential immigration. The other side, you get potential growth dampening on higher corporate taxes, which just means that we then have to turn our minds to the bond market. And how does the bond market digest all of this? We do know that the bond market did not like the higher treasury issuance in the third quarter of 2023. Treasury yields went up by 150 basis points, and valuations within the equity market hated it. So we do think that instead of this idea of buy the rumor, sell the news with the election, that the election itself could be a source of volatility if it results in a sweep.
That could be cataclysmic. Cameron, thank you. Did I do that right?
You got
I think
it,
I did.
yeah.
Thank you. All right, second go. Cameron Dawson of New Edge Wealth. Cameron, thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Millions in Florida are bracing for Hurricane Milton. The storm was just downgraded to a Category 4 and is expected to make landfall very early tomorrow morning. Forecasters are anticipating the storm will deal a serious blow to the Tampa Bay area. Milton has sustained winds of 160 miles per hour, strong enough to tear homes apart, and a storm surge capable of dangerous flooding in some coastal cities. Meanwhile, General Motors is working to lower the cost of its electric vehicles. During an investor presentation yesterday, the Detroit-based automaker hinted at a new lower-cost electric pickup truck with a 350-mile range. GM's vice president shared that the company is also working to secure a supply of lithium iron phosphate batteries in North America, a move that will help lower EV production costs. And a new documentary about the origins of Bitcoin may have uncovered the mystery of who created the cryptocurrency. The HBO film titled Money Electric points to Canadian software developer Peter Todd as the man behind the alias Satoshi Nakamoto. The documentary's creator uncovered early posts on Bitcoin forums to track down the creator's identity. However, Todd shrugged off the idea and called the suggestion ludicrous. Nakamoto is believed to hold around 1 million Bitcoin, worth over $62 billion at current prices. That's your Bloomberg Brief. John?
Okay. Thank you, Yahara. Can you imagine how, I would just say that would just be the boring end to a movie just to find out his name was Peter.
Peter Todd, like the most basic
Nothing wrong with the name Peter.
No, nothing wrong with it at all.
But Peter's out there, nothing wrong with that.
But it's like every, couple months there's like a new inventor that someone has found. They always deny it, and, it's just another one.
I want to find this guy on an island somewhere, billionaire, living it up.
He was a professor at McGill. He's way too, wholesome to be the creator of Bitcoin.
Who knows? Up next on the program, the Morning Calls Plus, Geetha Raghunathan of Bloomberg Intelligence on Hurricane Milton's impact on the Walt Disney Company. That stock's down a third of 1%. That conversation just around the corner.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
A little more than 1 hour away from the opening bell, equity futures just about unchanged on the S&P 500. No drama here. Yields pushing higher again, higher by 3 basis points on a 10-year, 4.04%. As crude turns higher by 0.1%. The relationship between those two things over the last few days, Danny, pretty well established. The moves in yields, the moves in oil.
And it's interesting because they've been based on different things. To start the week, it was geopolitical concerns, and the end of last week, too. Yesterday, it was China moving things. But how much will it really impact? To what level does oil need to be that inflation is a concern? Bank of America says that for every 10% rise in oil prices, it's 7 percentage points to core inflation. In other words, oil needs to get above $100 for there to actually be an impact. So they say we're not there yet.
WTI, 73.60. Let's get you some morning calls. First up, Jefferies upgrading Southwest to hold, saying management is taking the right steps. That stock is up by 1%. Your second call from Loop Capital upgrading Home Depot to buy, expecting higher demand due to the impact of hurricanes. That stock is up by 1.3% in the pre-market. And finally, Goldman Sachs keeping a buy rating on Disney, noting Hurricane Milton could cause losses of $150 to $200 million for the parks division. That stock is down by 1/3%. Sticking with the Walt Disney Company, the company closing its Florida theme parks in phases starting at 1 p.m. Eastern today. SeaWorld and Universal Studios also planning to close as Hurricane Milton barrels towards Florida. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, let's start with the Walt Disney Company. What steps are they taking as Hurricane Milton heads to Florida?
Yeah, so they are, as you just pointed out, John, closing the parks. And they've done this typically whenever we've had, Category 4, Category 5 hurricanes. The most recent one that comes to mind is, Hurricane Ian in 2022, and then you had Irma in 2017. Obviously, they take the utmost precaution in terms of closing their parks, but this does have a huge economic impact for, of course, the whole economy and definitely for the Walt Disney Company.
As Goldman indicated, if you go back to Irma, it wasn't just the parks closed for a couple of days. It was also multiple cruise itinerary cancellations as well. Geetha, given the strength of Hurricane Milton currently, how are you thinking about the damage done, the consequences outside of the theme parks, and what kind of duration are you thinking about?
Yeah, so they had a Disney Wish cruise line that was set to sail on October 11th, which they've canceled. They've rerouted some of their other cruise ships. But yes, it does have very, very wide-ranging implications, John. So we ran some numbers too. We think, of course, that the minimum damage that Disney will see in its fiscal first quarter operating income for the park segment is going to be at least about $125 million. It will have impact, of course, on the cruise ships. And remember, Disney is already battling softness, a softer demand at its theme parks. We've seen kind of attendance being a little bit flattish. We think now it'll be down, maybe almost low to mid-single digits for the current quarter. So it's definitely going to have a prolonged impact. And then remember, as we get into 2025 and maybe attendance starts to recover a little bit, but Disney is going to have the additional problem of a new Universal park that is going to open in Orlando. So we're seeing some prolonged impact for Disney, not just from the hurricane, but from overall theme park softness and competition.
Why then, Geetha, is Disney saying today that they're going to raise prices in Disneyland in California by about 6% on the most popular days? Do they even have that pricing power right now?
They do. So if you just kind of look at the parks business, parks is now the bread and butter of the Walt Disney Company. So even as, maybe just about 4 or 5 years ago, parks made up only about 35 to 40% of profit. Last year, it was almost 65% of profit. In fiscal 2024, it'll be about 60 to 62% of profit. So it is becoming a bigger and bigger portion of the profit pie as the linear networks are in secular decline and streaming is yet to really turn a significant profit. So parks are definitely important. And as they kind of see the slower demand, they have to kind of offset some of that slower demand by raising prices. The problem and the tricky part for them is they shouldn't price themselves out. Of course, I do think that they do have pricing power. They are undertaking this huge expansion across all of their properties, including Disneyland in California, which kind of, allows them to add attractions and allows them to, I think, charge a little bit more, especially with dynamic pricing.
You did mention, though, that they're going to face competition from Universal. And then, Geetha, you add in the cost of this hurricane, and then you add in people potentially being slow to go back to Florida, to go to places like Disneyland, Orlando. How do you see margins evolving over the time period?
So margins actually for the domestic parks business has been extremely strong. And this was a host of different things that they instituted through the pandemic. As you know, the parks were shut, there were so many operational efficiencies that they kind of put in place. And we saw margins kind of go from, you know, the high teens to almost the mid-20s and kind of inching their way even to, you know, the high 20s. And, you know, of course, we think that this is going to have a little bit of an adverse impact, just the overall theme park softness. Of course, you have the hurricane. But I think over time, we're definitely going to, you know, the parks business has always been a resilient business. And I think over time, it'll definitely trend towards, you know, the low 30s.
Over time, it's been resilient, but the CFO was talking about in August that actually it was a little bit softer, and he told us on Bloomberg TV that they were waiting for people to maybe stop going to Europe for their holidays and look more domestically. What is the cadence right now of people wanting to get out and that appetite to actually go to these theme parks?
Yeah, the appetite really has not been there. So, you know, the way that they kind of characterized the situation was that the lower income customer or the lower income consumer is actually facing a lot of financial stress. Theme park prices, of course, have risen almost 35% over the past 7 to 8 years. So yeah, they're definitely feeling that inflation. And then the higher income consumer, of course, traveling internationally. So that will continue to, I think, be a problem through most of 2025. And which is why we're kind of definitely going to see some amount of park softness. And we think there'll almost be $1 billion of an EBIT hit to the parks over the course of fiscal 2025 just because of that theme park softness.
Keith, I've got to squeeze this in every time we talk about this company. Have we found a new CEO yet?
Not yet. But they are searching. And, you know, you have, of course, the front runner, I think the 4 internal candidates, the heads of, you know, the park, the TV business, the film studio, and, of course, Jimmy Pitaro. Dana Walden looks like she's the front runner, but again, too soon to say.
They should just make a movie about this one. Geetha, thank you. Geetha Raghunathan, Bloomberg Intelligence. It'd be a very long movie. It's been going on a very, very long time. Let's get you an update from the National Hurricane Center. This is the latest, all subject to change. We understand the hurricane has weakened to a Category 4 hurricane on a 5-level scale. The latest update came about 24 minutes ago from the National Hurricane Center. They said Hurricane Milton was moving northeast at 16 miles per hour. I can share this quote with you. Winds will begin to increase along the west coast of Florida by this afternoon. Preparations, including evacuation, if told to do so, should be rushed to completion this morning. This really is, Danny, a final warning.
It is a final warning. Again, after we already heard from the Tampa mayor saying, if you choose to stay in one of these evacuation areas, you are going to die. Officials there saying roads saw 150% of normal traffic on Monday. So it does seem that people are heeding these warnings, that they are getting out. Just their ease and ability to do so is the question.
Also, Palm Beach County now issuing a mandatory evacuation order this morning. So basically, some of these counties that actually weren't in the path, they're now saying, better be safe. This could move. What we heard from the weather correspondent earlier, this could move path. So they want people to be safe first and foremost.
AccuWeather speaking to us a little bit earlier this morning, suggesting that we'd see landfall at about 2 a.m. a little bit later on overnight this Wednesday night. The National Hurricane Center, that's the latest from them in an advisory from about 25 minutes ago. Up next on this program, Tiffany Wilding of PIMCO and Amanda Liner of BlackRock as we count you down to CPI data in America. That CPI data 24 hours and 5 minutes away. We'll bring you a preview in just a moment. Equity futures on the S&P 500 as we count you down to the opening bell in about an hour and 5 minutes, negative by 0.06%, with yields pushing higher by another 3 basis points at 4.04%, and crude just about unchanged this morning on WTI 73.55 from New York City. This is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I forgot to say before we went to commercial break that Danny's gone on an assignment, so you're going to see a spare spot around the table. She's not ran off. She's got an assignment, and you'll see her later on Bloomberg TV with a special guest. 1 hour away from the opening bell. Equities right now on the S&P 500, just about unchanged. On the Nasdaq, we're down by 0.1% after a big run for one particular tech stock, NVIDIA. Let's get you some movers, some morning movers with Katie Graffeld. Hey, Katie.
Hey, John. Well, as you know, the U.S. is weighing a breakup of Google, specifically the DOJ yesterday, saying in a court filing that the agency is considering asking a federal judge to force Google to break up and sell off parts of its business, rather. Needless to say, that would be historic, but the fact alone that it's being considered maybe is somewhat expected, hence the muted reaction in shares right now, currently off about 0.5% an hour before the bell rings. But zooming out over the past 3 months, this obviously has been a weight on Google and Alphabet, currently down about 13% since July. Moving on, taking a look at shares of Boeing right now. Of course, that strike is barreling on. As you know, of course, production has been shut down on the West Coast for nearly a month now, and the news being that Boeing withdrawing its contract offer to its union. Making matters worse, you also had S&P Global Ratings coming out and saying that they're considering downgrading this company to junk. That's worth another 1.6% decline on Boeing. Let's end with some good news here. We do have NVIDIA, of course, the big leader in this market. It's up about 1.2% today. NVIDIA out with two pretty specific announcements, including a strategic partnership with Accenture. You also had Jensen Huang saying that the future of AI will be services that can reason. That sounds a little bit scary, but the stock seems to like it.
Katie, thank you. Appreciate it. Look out for Katie Shinelli and Matt Miller in about 30 minutes' time on Bloomberg TV. What a run on NVIDIA. 5 days of gains over that period. A move of more than 13%. We're talking about an additional $390 billion of market cap. As always, one to watch going into the opening bell. Your week ahead looks like this. At 8:30 Eastern Time tomorrow, we'll do jobless claims and CPI. Later on this afternoon, we've got some Fed minutes coming up. And then as the week progresses, it's all about Friday and bank earnings. JP Morgan and Wells Fargo just around the corner. With us to look ahead to that economic data, joining us now is Amanda Lynham of BlackRock. Amanda, good to see you.
Good morning. Thank you for having me.
Big questions about the payrolls report, the veracity of the data, the sustainability of the data, and whether it means this Fed's got to back away. When you think about what we could get from CPI tomorrow morning, how are you recalibrating your thoughts about what to expect from the Federal Reserve?
Right. So I think the way that we're thinking about it is that presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important. There's a lot of consternation in the market about, will we get as many cuts as were previously priced even a couple of weeks ago? For corporate credit, so long as those cuts are being reduced because growth is high, that's a backdrop that credit can easily absorb, and you're seeing that with credit spreads. What's been so notable to us, I would say maybe a couple of months ago when we would talk about revisiting the mid-2021 tights on credit spreads, we would get some pushback. Now the market conversation is, can we go even tighter than that? And that has been really telling, and we were talking about it all morning, above trend growth, Fed that is poised to cut, just determining how much. Those are good outcomes for credit.
It tells you about the bias of the market right
Yes,
now that
it
we're now
does.
asking how tight we could go on corporate credit spreads. Let's talk about the contradictions in the economic data. Last week, prime example, there was something for everyone in the economic data last week up until that blowout payrolls report. You could see it in consumer confidence. You could see it in the jobs data, the fact that hiring was down, the quits level had dropped. And then we had this blowout report. And the word that keeps coming up, contradictions. Yeah. Contradictions in the economic data. There's a word that I keep seeing in the work that you do, bifurcated. Does that explain the contradictions?
I think it does, because there is no one consumer. There is no one savings rate. Even looking at the economy, it's much more of a services-led economy than a manufacturing economy. So I think the mix shift of the economy is changing. The underlying kind of dynamics are different between whether it's consumer, commercial real estate, corporates. And then I also just think from the perspective of we're still unraveling some of these post-pandemic shifts. And so some of the old playbooks, the old economic rules, the inversion of the yield curve, the SOM rule, right? Those were pretty reliable recession indicators in cycles past, but I think there is a big question as to whether or not we can use those same kind of guardrails in assessing the economy today, and I think that's really what's underlying a lot of this.
John's been bringing up Ally Financial, which is a really good point. About a month ago, how they're talking about this intensification of what's going on, the credit challenges. Is that just for one side of the consumer?
Well, I think the subprime consumer is unquestionably under pressure because even as inflation is improving, they're still dealing with the higher price pressures. You had mentioned kind of that divergence between auto delinquencies and home price delinquencies or mortgage delinquencies in the economy today. I think one part of that is that consumers want to protect the value in their home. They've seen their home appreciate as a pretty significant asset, up say 55% using the Case-Shiller Index since 2019. So you want to protect that at all costs. So it does seem like the way that consumers are prioritizing debt payments has shifted across the asset types.
Can you take us inside the credit market then and talk to us about how well priced the story is that you describe? Yeah. Of all these consumer-facing companies, if they are dependent on one cohort of consumers versus another, are you seeing that discrepancy, that dispersion?
I will say the overarching theme in the corporate credit market is interest in laggards and whether or not they will catch up. And so I do think this is the point where we need to be discerning. For most of this year, triple Cs have lagged. Even retail was never really underperforming in the credit market, but you did see kind of that lower quality cohort of triple Cs lagging for most of the year. That underperformance gap has closed pretty substantially. Triple C spreads are now just above 600, which is slightly wider than where they should be given the high yield index level, but not materially so. So it seems to me corporate investors are kind of looking at the landscape. This is in IG and in high yield as well, and saying what has underperformed that I think is unwarranted, and can I step in? Now, the overarching headwind of the election hangs over that, especially if we get some meaningful impacts to tariffs. But I would say it's very much a risk-on tone in corporate credit. It's very much a what has underperformed that I think you might take the other side.
This is the second time that you've pointed to a really bullish bias in this corporate debt market. Yes. Is it uncomfortably bullish?
In certain instances, I think it can be, but I think importantly, we need to be respectful of the technicals, which, as you know, are so important in the corporate credit market. We've had very limited net supply. We've had significant demand from yield-based buyers. When we've had backups, they've been quickly bought. We're reinvesting higher coupons on an ongoing basis into this market, which is also absorbing that. And so we are very mindful of where are the fundamental risks, but I do think there's an opportunity cost to being underweight risk assets more broadly, and I think we have to be respectful of that. And within reason, we're treading pretty carefully.
Hearing you speak, hearing you talk about these issues, it begs the obvious question: why is the Federal Reserve reducing interest rates? Going into what you described.
Yeah, I mean, I think they've said as much that they don't know where the neutral rate of interest is. You know, that 3.5% that we're looking for next year is where we believe, pending additional information, where they can cut. There are pockets of weakness. Anne-Marie, you mentioned the subprime consumer. The leveraged loan default rate is approaching 7% on an issue-rated trailing 12-month basis. Still increasing. High-yield default rate has decreased. So in aggregate, credit has been resilient, but under the surface, there's a lot of bifurcation. No exception there. So I do think in order to stem the weakness that we've seen in certain cohorts, the Fed will continue to normalize, but we're not expecting easing. That's the real distinction for corporate credit, is normalizing.
You mentioned the election, this potential of tariffs. These things would unnerve investors. When do they start to price that in?
Right. So the way that we're approaching it is that the paths can be so binary that you want to be positioned so that you're not caught off sides either way. There are certain things that we expect to be prevalent no matter who wins. Higher deficits, some protectionist policies. The AI spend probably still continues. For that reason, we like financials actually, because it's not subject to making a widget and shipping it across regions. It's not subject to the trade and tariffs. So I think there are ways that you can position around the corner. But I do think we just need to see what happens here and build in some nimbleness in portfolios that you're not caught off sides either way, but that you can make some directional shifts. But we're seeing a little bit of volatility, I would say, around that. You were talking about it earlier this morning, but no major shifts to a large degree. I think it's just too close to call.
Big week for the financials with the banks reporting on Friday, including JP Morgan and Wells Fargo. Let's get you the latest from PIMCO. Here's a quote from them. The US economy, like others, appears poised to achieve a soft landing, moderating growth and inflation without recession. But there are risks, such as the upcoming US election, and its implications for tariffs, trade, fiscal policy, inflation, and economic growth. Joining us now on their outlook is Tiffany Wilding of PIMCO. Tiffany, welcome to the program. Lots to work through with you. The economic data so far in the last week, payrolls on Friday, CPI tomorrow morning. How old are those numbers going to look by the time we've worked through the election and have a better picture of what 2025 looks like?
Yeah, so I think that's a really great point. We have an incredibly big election on the horizon here with policies with either candidate that could look very different. Of course, the deficit we think is really the real loser here, with neither candidate likely to do anything about the longer-term trajectory of government debt. But I do think that there are bigger differences within trade policy, and that will matter for markets. Trump obviously has former President Trump has been discussing policies that could be quite disruptive just in terms of their scale and scope if they're implemented the way that he's discussing. So I think that you have to be mindful of that type of risk, and as a result, you have to keep a pretty defensive portfolio.
Is this potentially the biggest risk to the soft landing, the U.S. election?
Yeah, I mean, certainly, when you look at the tariffs and the the aggressive nature with which he's talking about doing them, 60% on China, 10% everywhere else, there's a quote transition cost to that. The economy will have to transition to some new place after you implement those, and it would likely cause elevated recession, elevated inflation, the potential for recession. It would be a really tricky spot for the Federal Reserve as a result. And it just creates business uncertainty. So you don't have businesses that want to invest. You don't have consumers that want to buy durable goods, for example. And that's happening potentially on a global scale. So I think there's definitely some huge risks here around the election. Now, there's a question around if he and will he implement the things that he's talking about. Of course, President Trump obviously likes to look at the equity market as a barometer of his overall success. We can't imagine that the equity market would do well in that kind of scenario, so probably will temper him, but nevertheless, it's a risk that markets and portfolio managers have to deal with.
Maybe making quick U-turns on policy depending on how the S&P 500 or for the former president, the Dow Jones does on a specific day. You mentioned the deficit, fiscal policy, both these individuals, vastly different corporate tax rates. What does that mean for the overall health trajectory of the U.S. deficit?
Yeah, well, really the longer-term issues around the deficit, are less about these, more discretionary pieces that are being discussed. They're really about the non-discretionary programs and the trajectory of demographics in the United States. So like Social Security, Medicare, and Medicaid. Neither candidate has said that they're going to touch either of these programs, and you really can't change that longer-term trajectory without doing so. So as we sort of suggested, this is really just, tinkering around the margin. We think they probably will come up with a plan. We have to, we're dealing with the Trump tax cuts, the Tax Cuts and Jobs Act extension. Most of those will probably be extended. Potentially, there could be some pay-fors. Of course, the Harris side is talking about through higher corporate tax rates, while the Trump side is talking about raising money through tariffs. So, there certainly will be differences, but overall, we don't think it's going to make a huge dent in the longer-term trajectory of the U.S. debt.
Tiffany, we'd really appreciate your outlook as well on the upcoming information that we'll get off the back of the hurricane that's about to strike Florida. The incoming economic data might be very distorted, muddied by the hurricane that we've had before, Hurricane Helene, and the one we're about to get overnight, Hurricane Milton. The fact that in between some ports were shut as well. How are you and the team thinking about the incoming data over the next month or so off the back of those issues?
Yeah, well, certainly it's going to be noisy. The first issue is just that there is a reduction in activity, usually in the month when the hurricane hits. But then afterward, there is more rebuilding. We obviously, our hearts go out to the folks that will be impacted. But just from an economic perspective, you do tend to get a bit of a surge in activity after these kinds of events. Again, just because of that rebuilding. You also tend to just get more inflation. Used car inflation as you have an increased level of flooding that is resulting in replacement activity for cars tends to rise. So, it just tends to, create a kind of inflationary environment. And that's something that the Fed is going to have to watch. Now, we don't think that, the impacts will be like what we've seen over the past few years in terms of inflation. But it's certainly something that, could keep the Fed on edge, over the next several, quarter or so, as we're kind of working through the effects of this in the economy.
On edge and not on pause, not on hold?
Yeah, well, our own view is that the Fed has a range of scenarios here. They can continue a sequence of rate cuts, and we compare their policy rates to Taylor rules. Things, kind of normative rules of where policy can be, and they have a lot of room to cut interest rates here. So, they waited, they were delayed in cuts relative to what their own rules would have suggested, and now they have, more room. And we think as a result of that, they probably are embarking on a sequence of cuts, 25 basis point rate cuts. We think the recent data, by the way, has taken some downside risk out of that. But 25 basis point cuts at every meeting between now and, say, March, before you slow down to try to figure out where the neutral rate is, seems reasonable to us. You see how the economy responds to that, and then you go from there.
Tiffany, you make it sound easy. It's good to catch up. Tiffany Welding there at PIMCO. Appreciate the update. Amanda Lana of BlackRock still around the table with us. Amanda, just a final word. Do you see it the same way as Tiffany? Are the cuts easy up until March?
I think barring some kind of extraneous events, yeah, I think they are. I think there's a pretty wide agreement that we're above neutral, but how far above neutral is really the question here, and I think that's really going to matter. But again, if we don't have as many cuts delivered because growth is supportive, that's an okay outcome for risk assets in our view.
Amanda Lana of BlackRock, appreciate your time. It's good to see you this morning. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. The Kremlin confirmed that former President Donald Trump sent Russian President Vladimir Putin COVID-19 testing devices during the height of the pandemic. The claims were first reported in a new book by Bob Woodward. As for another claim made in the book that the two leaders had spoken by phone several times since Trump left office, the Kremlin denied that one. Meanwhile, fewer people in the U.S. are applying for mortgages. Applications fell for the second week in a row last week. They were down by 5.1% from the week prior. This coming as U.S. mortgage rates jumped last week by the most since July 2023, putting an end to a months-long slide that was helping revive housing activity. The contract rate on a 30-year mortgage rose 22 basis points to 6.36%. And the Minnesota Lynx are heading to the WNBA Finals after an 88-77 Game 5 victory over the Connecticut Sun. Minnesota was led by Defensive Player of the Year Nafisa Collier, who had 4 blocks in addition to scoring 27 points. Minnesota will be looking to win its 5th championship in franchise history, which would be a league record. The best-of-5 series against the New York Liberty begins tomorrow night in Brooklyn. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate your word this morning, as always. Wanted to fit in this as well. One of the biggest stories in this nation at the moment. All eyes will be on Florida as the state prepares for Hurricane Milton. Joining us now is ABC's Rena Roy from Tampa. Rena, walk us through the time you expect landfall, the intensity as this hurricane evolves, and how things are tracking currently.
Yeah, well, John, I can tell you that about 6 million people across 11 counties here in Florida are under mandatory evacuations. And you can see right behind me here that rain is coming down. It has gotten more consistent and heavy as the morning has gone on. We've also started to feel some gusts of wind as well. You asked about landfall. Well, that is expected to happen sometime tonight between 9 p.m. and midnight as a low-end Category 4 hurricane, bringing up to 18 inches of rain and a record storm surge of up to 15 feet in the Tampa Bay area. It is unclear where exactly landfall will be, but at last check, the path was veering slightly more south near Sarasota, and it is all hands on deck here. The governor says the National Guard storm mobilization is likely the largest in state history, with thousands of troops activated. And some areas are now actually extending evacuation orders further inland due to storm surge concerns there as well. John?
Earlier on this hour, Rena, we got an update from the National Hurricane Center. Came in at about 8 a.m. Eastern time on the category of the storm, dropping back from maybe a 5 to a 4. Could you walk us through the difference there and how small a change that might be?
Right. Well, when we talk about categories, we're talking about the wind per hour. And so right now it's kind of fluctuating between 3 and 4. It's unclear because things are going to keep changing throughout the day. We do know that this hurricane is getting larger and the wind field is widening. So we know that there was going to be some pretty widespread destruction here.
Rena Roy, I know you've got to go. Appreciate the update this morning. Thank you. And we'll catch up with you tomorrow, no doubt, as well. Stay safe. Rena Roy there of ABC. The latest on Hurricane Milton as it barrels towards Florida. Expected to make landfall later on tonight at about 2 a.m. Eastern time, according to the latest from AccuWeather. Up next on this program, we'll set you up for the day ahead, the trading diary, the calendar for the next few days. From New York City, this is Bloomberg.
Is the Vivian Tom clientele? Yeah, power women, like the dragon, dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
38 minutes away from the opening bell. Equity futures right now on the S&P 500, just a touch softer, as they have been all morning. No real drama, though. We're negative by 0.06% on the S&P, following a gain of almost 1 full percentage point in yesterday's session. Thank you, NVIDIA, for supporting this market. So Thanksgiving period coming up. Thank you, NVIDIA. You know what I'm talking about. A 5-day gain on the stock of more than 13%. Over those 5 days, we're talking about adding $390 billion to a single name. It's a ridiculous run, and it's up another 1% this morning on that stock in the pre-market. That's the story of the equity market so far. Switch on the board and get to the bond market. Earlier on in the last week, we had a 2-year and a 10-year breach 4% for the first time since August. We're back to where the front end of the curve, the move sticks to the long end. We're up another 2 basis points on a 10-year at 4.03%. The move in crude. Also, the first time since August, we saw a breach of $80 on Brent crude. Since then, we've backed away. We're down 0.6% on Brent crude, 76.72 on WTI, 73.
Any sort of inclination of a wider conflict, prices will spike again.
Let's just sit on that. We were expecting the defense minister to come from Israel to Washington, D.C. We were looking to see what would happen. There was a feeling that maybe an attack wasn't imminent. Where are we now?
Well, the defense minister is no longer coming, and Israeli officials basically said that Netanyahu is going to decide what to do and is going to get a phone call with President Biden today. They haven't spoken since August. I read this as the United States was trying to basically calm down Netanyahu or basically just buy time. The defense minister coming here means there's not going to be an imminent attack. Now, potentially, at least reading the tea leaves, maybe there would be something sooner, as in this week, in terms of that retaliation.
Commodities down across the board here. We mentioned energy pulling back. We're down by about 0.5% there on WTI and on Brent crude. You're seeing it in base metals. On copper in London, we're down 0.8%. Precious metals, similar move, just a little bit softer. We're down 0.1%. Amri alluded to this, the China piece of the puzzle. We'll get more on that over the weekend. Looking for an update on fiscal policy from Chinese authorities on Saturday. Look out for that briefing. As we count you down to the opening bell, the other things to look for through the next couple of days or so. Fed minutes coming at 2 p.m. Eastern this afternoon. Look out for that following that 50 basis point interest rate cut from the FOMC. This is the details of what happened in that meeting. Remember, they can massage some of this, so look out for that a little bit later this afternoon. Tomorrow, we'll get CPI and another round of jobless claims, plus Delta reporting earnings. On Friday, PPI and New Mitch consumer sentiment. And a big one, earnings season really ramps up. We'll hear from the major players of Wall Street, kicking things off with JP Morgan and with Wells Fargo. Look out for that on Friday morning. Coming up tomorrow to break down all of these themes and look ahead to that economic data, we'll catch up with Brian Levitt of Invesco. We'll speak to Dan Greenhouse of Solace Alternative Asset Management. Mike Wilson of Morgan Stanley earlier this week, overweight consumer cyclicals. We'll break down that call with him tomorrow morning, and we'll speak to Erica Najarian of UBS on the upcoming bank reporting season. As we count you down to the opening bell, 35 minutes away, equity futures on the S&P 500, just a little bit softer, basically unchanged. We're negative by 0.06%. And in the bond markets, as we said, repeated all morning, we hold on to that 4% yield on a 10-year yield, up by 2 basis points this morning. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Oh, why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
We are looking at futures down again after making up yesterday all that we lost on Monday. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment and Bloomberg Open Interest. It starts right now.
Coming up, big tech crackdown. The Justice Department is weighing a Google breakup in an historic antitrust case. Meanwhile, Boeing withdrew its contract offer, saying talks with its largest union don't make sense at all at this point. Plus, we're going to get minutes and a chorus of Fed speakers today. This hour, former Kansas City Fed President Esther George joins the show. First off, let's take a look at where markets are trading. In terms of futures, as I said, we're down, but not by very much. Only about 5/10 of, 5/100ths of 1%, I should say, on the NASDAQ 100 futures, more than 1/10 of 1%. Katie, yesterday we made back literally all of what we lost on Monday.
We certainly did, and taking a little bit of a breather this morning at the index level. Let's take a look under the hood, see if we can find anything more exciting. And right up top here, you actually have U.S.-listed miner Arcadium Lithium will be acquired by Rio Tinto for $6.7 billion. That's a 90% premium from Arcadium's closing price last week. And as you can see, shares currently up about 30% as a result pre-market. Moving on, you do have Boeing, of course. Shares lower after negotiations to resolve that manufacturing strike collapse. We're entering a fourth week of the strike. It's been nearly a month. You also have S&P Global warning that it may cut the plane maker's credit rating to junk. As such, shares currently down about 1.7%. And let's check in on Alphabet, of course. It's a little bit lower as antitrust officials consider forcing Google to sell off parts of its business in what would be an historic breakup, Matt. But of course, we've been dealing with this headline risk for a while. And as such, shares only down about 0.4%.
Yeah, that's because we knew this was an option back on August 5th. When the judge handed down his decision on August 14th, we wrote a story citing people familiar that said this is an option. And the new news today is that the Justice Department has confirmed that it is one option that they're considering. What I find interesting is that there's so much dominance in terms of ad revenue from search. I would have thought that it all comes from video. You can see from this chart that $457 billion of all online ad spending is estimated to come from search for this year. only $103 billion from video, but you have to imagine that Google dominates there as well with YouTube.
Yeah, you're certainly right, of course. This obviously is a big, sprawling empire, and you can see that reflected in the chart. I will say, of course, even though, you know, this is very incremental new news, this has been a big weight to Google, to Alphabet, rather. Over the past 3 months, it's down 13% since about July 10th or so. So obviously, it's been weighing on the
Which
stock.
is, you know, big for a $2 trillion
You've been feeling it at the index
company.
level.
I have been feeling it.
Oh, yeah. In your
Specifically.
401k.
Let's get more into the potential Google breakup with Bloomberg Technology Co.'s Ed Ludlow in San Francisco. Ed, as Katie points out, this does feel extremely incremental. I mean, have we moved anywhere at all since August 5th? We don't even have this part of the case starting until spring of next year, and then we don't expect Meta to make a decision until August of 2025.
You did very well to recount the timeline and chronology, which is that Bloomberg had reported that the DOJ would do this. And I guess, look at the stock. I think we're down a few tenths of a percent in pre-market. The sell-side note from JP Morgan is, well, the DOJ saying it's considering proposing to the judge a remedy of breakup is well within its playbook. So it's not really a surprise to anyone. It's a 32-page document that in 1 month's time, they'll tell us a bit more about, and there's a number of options on the table. A little bit more interesting to me is the data, because in the world that we operate in over here on the West Coast at least, the data behind search and the data behind AI, which Google is in a competitive field in, one of the other proposals from the DOJ is that the court enforce Google making that data available to its competitors. Now, that would be an interesting development, but what they don't do in that document is explain what breaking up looks like, at least in the 32 pages that I read.
And of course, Matt is really determined to make this not interesting, but let's knit this into the broader context, because you think about big tech, it feels like overall we've seen this massive crackdown coming from antitrust regulators who've been feeling, it looks like, pretty emboldened.
Yes, there are two bodies involved here, the Department of Justice and the FTC. And it is not just Alphabet, the parent of Google. They have looked also at Amazon and at Apple, other mega cap technology companies. They have looked at their investments in the field of artificial intelligence technology. I think that what's interesting in this specific case around the search business is the idea that you would go to Alphabet or Google, let's just call it Google. Search is its bread and butter. When you go to FAGO on the Bloomberg terminal, it is the most important part of earnings. And it would be the biggest antitrust action in this country since Microsoft 20 years ago, which I think the three of us talked about. I actually have a kind of sense of deja vu, because Matt is really right. Nothing has fundamentally changed since August. But this is a part of a much broader initiative, and it's not unique to the United States because Europe is looking at it as well. The point being in all of this, nothing's yet happened. And so then if you're an investor, you have to weigh up the what do they call those markets? The arbitrage risk of whether something does in the end.
Well, Ed, we will certainly have this conversation again, so we'll
many times before August of 2025.
A lot of deja vu coming your way. Great to see you, though. That, of course, is Bloomberg's Ed Ludlow. And tune in today for the kickoff of Bloomberg Screen Time in LA. It's a gathering of business leaders, celebrities, entrepreneurs defining the next phase of pop culture.
You know what I'm pumped about?
Tell me about it.
Ed and Caroline have a special show on Friday. Bloomberg Tech on Friday will be at Rocket Labs.
Yeah.
And to me, that is fascinating. When I can hear Ed Ludlow reporting on rockets, I'm tuned in for the whole hour.
I know. I hope they just have, of course, a backdrop that's just stars and space, and that'll be a lot of fun to watch. But don't go anywhere, because we have a great conversation coming up right now. Let's welcome in Sarah Malik. She is head of equities and fixed income, also chief investment officer over at Nuveen. She oversees more than $1 trillion in assets. And Sarah, it's great to have you with us. It feels like there's so much uncertainty in this market anywhere you look. One of the big things, of course, is the election coming up in 26 days. Between now and then, over the next 26 days, how seriously can you take any one day of action across any market right now?
I think there's three things that markets are worried about until we get to the election, and that's inflation, upcoming third quarter earnings and this backup in yield. So let's start with inflation on deck for this week, CPI and PPI. I think CPI likely comes in hot for a second month in a row. We'll be closely watching three areas. That's airfares, autos, and shelter prices to see if any of those remain hot or heat up again. And then PPI, the interesting thing there is to watch what feeds into PCE, which is the Fed's preferred barometer of inflation. On PPI, we'll be watching closely for portfolio management, healthcare services, and airfare. That tends to lead into that PCE number. And secondarily is third quarter earnings. We're going to get a lot of earnings out of banks at the end of this week. That kicks off earnings season for this quarter. What you've seen is the typical analyst estimates have been going down leading up to this quarter, but we still have a pretty healthy about 4% earnings growth expectations year over year, led by technology. So those tech stocks, again, need to meet that high bar in order to help this earnings growth quarter. And then, of course, this backup in yields. Yields have been backing up because the economies remain strong, including with payrolls that we saw last Friday at about 250,000 payrolls for the month of September. But people are getting concerned that yields are now up for the 10-year up at 4%. So we have to deal with all of that before we even get to this election next month.
So there's a lot to drive volatility, Sarah. There's a lot to drive concern as usual, right? So much uncertainty as always. But what do you expect from stocks? Can we get through this to a higher level? I mean, 57, 51 is, I think, where we closed yesterday, which is already, more than most of the strategists in our survey expect for year-end 2024. Is this earnings growth that we expect going to be able to power stocks higher through the end of the year?
Well, we've seen volatility as measured by the VIX picking up recently. So this is telling you that investors are becoming more fearful because of these issues. And let's not forget also the unfortunate events unfolding in the Middle East, the impact that can have on energy prices and on global markets. And then, of course, China, that's been very volatile recently. Now, of course, moving back to the downside as a lot of this stimulus expectation was a letdown for investors. So I think markets likely at this level, the risk is to the downside, more volatility. We'll see with CPI coming in a little bit hot next month. I think people are going to say, you know what, the U.S. economy does remain strong and we can rely on that inflation is here to stay. It's still very sticky. We have uncertainty around this election. So, as long as the economy holds us up, that's great. But markets at trading, as you said, at about 5,700, I think the risk is a bit more to the downside than the upside for the near term.
So let's talk a little bit more about those geopolitical risks. Of course, a conversation we've been having on this show is how do you hedge it, especially when it comes to the oil market? I thought it was really interesting that you had BNP Paribas Exane cut its recommendations on BP, Exxon, a few other names on excess supply. And of course, you've seen oil move higher to those tensions that we're seeing. But it still seems like at the end of the day, it's supply that overwhelms everything else.
Yeah, and it's interesting, just looking at third quarter earnings, energy stocks are expected to perform the worst with earnings down over 20% for the third quarter. And that's going to be interesting, but with oil prices going up, of course, we're going to be more interested in terms of what are these companies' outlooks. We have to balance what's going on in the Middle East as a bit of a black swan event when it comes to energy prices, because we don't know how this will unfold. But of course, supply has been creeping up with OPEC and other areas. So, I think it depends. Energy in general has to do with what is supply doing? How does demand look? Demand looks pretty strong with the economy remaining strong globally and especially in the U.S. Now, what are producers doing? Are they returning cash to shareholders, or are they pulling more barrels out of the ground and increasing supply even more? For this cycle, producers have been more disciplined, but with energy prices and oil prices up at about the $80 level, I think similar to the markets, a little more downside than upside there because they have moved up quite a bit on these geopolitical risks.
We got a big positive surprise, Sarah, in our last jobs report. It looks like, maybe the Fed went a little too far with 50 basis points, maybe not. I guess it really doesn't matter 25 basis points in the big scheme of things, but we're going to talk to Esther George, formerly of the Fed, next. What would you ask her? What would you ask anyone on the FOMC right now?
I think the question is, would the Fed have still cut by 50 basis points if they knew jobs numbers were going to recover to this 250,000 level? The Fed's been very clear that they're focused on the labor markets, and labor markets have been coming in a little bit weaker than expected as we went into that September rate cut. And of course, now labor markets have rebounded. However, my caution with labor markets is that if you look at recessions, employment tends to crack right when the recession starts. So it's very hard to rely on employment data to predict a recession. So that makes it more challenging in this world of, are we going to get a recession? Are we we're not going to get one. We're closely watching the consumer trends. We'll see retail sales next week. What's the consumer doing? I am still concerned about a recession. I think this era of high interest rates and sticky inflation eventually will lead to that downturn. But of course, labor market's tough to predict. Did the Fed go too far in September? I think the answer is maybe once we saw this September payrolls number roll in at 250,000+.
All right, Matt, I hope you wrote that down for Esther George. Would she still have gone 50? Sarah, always great to speak with you. Really appreciate the suggestion as well. That is Nuveen's Sarah Malik. Now, coming up, as we mentioned, former Kansas City Fed President Esther George. She joins us from the Citadel Securities Global Macro Conference. That conversation next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I'm Shanali Basak. I'm here at the Citadel Securities Global Macro Conference, of course, for Bloomberg Open Interest. And I'm standing by now with former Kansas City Fed President Esther George. What a great time to have you a day before CPI, just after the last jobs print. That's actually just where I want to start because, of course, with jobs coming in hotter than every analyst and economist surveyed by Bloomberg, even revisions for the month before revised higher. Do you think, and I think this is the most direct question here, do you think that 50 basis points was too much?
Well, that will be something for history to judge, I think, in this scenario, but certainly how great to see a jobs report like that. But I would just keep in mind, it is one that will come in a series. And we have seen, because of how this economy is really trying to reach its footing post-pandemic, that we've seen things move up and down from inflation to the job market. So very much a welcome report, but too soon to draw big conclusions about what it might mean longer term.
Even in the near term, how much more room do you think it gives the Fed to cut for the rest of this year alone?
So I think what the Fed is trying to figure out is how to balance its two objectives. For thinking about the labor market, for making sure that it gets back to its 2% target in a timely way. It means now they have to judge risk around each of those. And as those come into better balance, as they say, they're trying to decide where to put the weight on that. And I think when you heard the chairman talk at the NABE conference that we're going to look at our SEP forecast, which shows 2 more cuts the rest of the year. That's a baseline, but I think not a given yet until we see how some of the other data, including tomorrow's print,
well,
comes
let's
out.
go right there. How comfortable are you that we're on a path sustainably to 2%?
So I think, like others, I'm confident that we have seen that inflation come down. But I've always been among those that believe this last mile can be the most difficult, because now you're trying to get from something in the neighborhood of 3% inflation to 2%. And over what period of time can you do that and still ensure that the public believes you will get back there, that those inflation expectations stay anchored? So I remain pretty focused on where we are with the current inflation dynamics.
Hey, Esther, Matt Miller here in the studio at 731 Lex. Really appreciate you joining us today. I want to ask about the Fed's data dependency. Is it too sort of immediate, too much in the now? Do they need to look ahead if we get, for example, more deficit spending from the U.S. government, bigger debt, inflationary policies from whomever wins the presidential election? Should the Fed start to worry about that now, or just wait until it happens?
Well, they have to worry about it now in terms of developing what I call a set of scenarios that could unfold in the economy. And of course, that's at the root of how a committee, how forecasters develop a view of what the future looks like. So yes, they have to look at today's data to help shape that forecast. And that's why you hear them talk about being data dependent, is because each one of those data points has the potential to give them a different read on trends or something that's changing in the economy. But as you've noted, there are many things that right now may be question marks that lie ahead that they will have to prepare for when they think about it. And I think they have also noted, we think our policy is in a good place. In other words, we can move more aggressively if the economy weakens. We can stay longer at this interest rate if it looks like things are heating up again. And so they've given themselves some latitude, some options, if you will, for how to think about an uncertain future.
I also wonder about the Fed balance sheet. On the Bloomberg, we have a great function. If you type Fed, BAL, GO, you can see the enormity of it. It's come down, of course, from $8.5 trillion, but we're still looking at about more than $6.5 trillion. Can the Fed continue to run this off? Is there more room for quantitative tightening?
Well, if you follow the Fed's stated game plan, which is a goal to shrink that balance sheet to the smallest size needed to continue their operating framework, you would have to say, yes, there is more room to go. And it's a little bit of a dynamic of saying you are tightening by rolling off your balance sheet while you are easing the short-term interest rate. But of course, this is important, I think, in the long run for how the Fed conducts monetary policy, for the implications of that balance sheet, should they need more capacity at some point due to a disruption. And of course, they don't know the stated end point for this. So when people say, what will be the size of the balance sheet when they finish, that's an unknown. They have to watch the demand for reserves from the banking system. They have to watch Treasury market functioning to make sure that that remains healthy. And so I think it's an unknown destination at this point, but direction of travel, I think, really important in terms of how they've laid out their plan to reduce that balance sheet.
And Esther, this is Katie Greifeld sitting next to Matt in 731 Lex. I do want to build on what Shonali asked you, of course, about how much room the Fed has to cut rates. I'm curious about when you look at the dynamics of the inflation that we have in this economy right now. Of course, we got hotter than expected wage growth last Friday in the jobs report. There's some people saying that we could get a hotter than expected CPI report tomorrow. Could you see a scenario where actually the Fed stays on hold in November and potentially entering into sort of a stop and start rate cutting cycle?
Well, I think they will have to think about that depending on how, again, this report comes in, the composition of it, very important. So they've seen goods inflation really back off. Services inflation has started to come down. The housing component is continuing to stay sticky. And so with the CPI currently at a core level, running closer to 3, the PCE also running well over their target, they have to be very mindful because in the long run, inflation is what their policy toolkit is able to control. The labor market, of course, is a byproduct of how stable that inflationary dynamic is. So it remains a very key aspect of decision-making, I think, for this committee.
And Esther, I know it's an impossible question, but I am curious about where you think the neutral rate might be in this cycle, of course, in sort of a range. I mean, do you think that we're going back to a 2.5% neutral rate, or do you think that maybe it could be a little bit higher nowadays?
Yeah, well, my view is that I think it is a little bit higher, and of course we don't know. The economy is still trying to find an equilibrium, I would argue, as is the Fed, trying to judge. We don't want to stimulate the economy. We don't want to slow it down unnecessarily. But knowing where that neutral rate is a tough call, and I believe you've heard the chairman say, we're going to kind of feel our way. We'll know it by its works. There are two things that I think, though, are important to look and why I would think that neutral rate is higher. One is looking at productivity growth. So that can bounce around, but we have seen some pretty interesting productivity come out of this period. That could mean that that neutral rate is higher. And of course, the other thing is looking at fiscal policy. With the level of interest that's compounding and the deficits that we see underway right now, that could also suggest we're going to have higher levels of interest rates. And this idea that we will be going back pre-pandemic looks a little more iffy to me than the period we've just come off of.
Now, I want to double down on just that point, because you were a co-signer to a report that came out this week from the Committee for a Responsible Federal Budget that says Vice President Harris, if elected, would add $3.5 trillion through the federal debt through 2035. President Trump would, however, add $7.5 trillion. No matter what, you have more, but it's the degree of how much more you see through their policies. How much uncertainty does that add to the interest rate outlook, in addition to the current debt load that you were talking about?
So for the Federal Reserve, they're not able to make decisions based on those kinds of potential policy agendas. And of course, a lot will have to happen next year for us to see how that unfolds. I think what's really important, and I hope what the sentiment of this letter was, we're already in a place that we need to address our fiscal situation. And depending on how elections go and how Congress and policymakers think about the U.S. fiscal position, it will have dramatic implications for the country. And so the sooner those are addressed, the more specifically they're addressed, the better it will be in terms of tackling what is an enormous problem.
We only have about 30 seconds left here, but do you think that there could even be a chance for an interest rate increase next year if these policies become inflationary?
Well, I think under different scenarios, of course, that could be an outcome, because that, of course, is a direct mandate for the Federal Reserve, is to try to head toward its 2% target. So a lot can happen between now and next year, and we'll have to stay tuned, as I know the Fed is.
Esther George, we thank you so very much for your time. Of course, that is former Kansas City Fed President Esther George. Guys, back to you.
All right, Shonali, thank you. And of course, we are less than 4 minutes away from the opening bell. Quick check on markets right now. Of course, you can see futures pretty much unchanged on the S&P 500, sort of taking a breather after the volatile 2 days that we had. We'll walk you through all of it once those bells ring. This is Bloomberg.
what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, we are moments away from the start of trading on this Wednesday. This is Bloomberg Open Interest. I'm Matt Miller. Right now, futures are unchanged, really, but a very cool fact, I thought. I was watching to see if we could get back yesterday all that we lost on Monday. Indeed, we did exactly. We closed yesterday at 57.51, and that's where we closed on Friday night as well. Maybe that's not as interesting as I thought it was. Here you hear the opening bells, and you see the opening bells ringing the New York Stock Exchange. This is interesting. Empire State Realty Trust ringing there, and they're touting the Empire State run-up. I imagine there's going to be a race where you run up all the stairs. I hope at least that's what it is. At the NASDAQ, you see AW New York, the Penn District ringing the bell. So a lot of very cool people, some celebrities hanging out there. In terms of the averages, what's going to drive us today? What's going to weigh on us? Could it be the fact that the Department of Justice has confirmed it is still considering the possibility of a breakup for Google, which it's been considering since the beginning of August and will consider until August of 2025. Let's go to Katie Greifeld. She'll tell us how that's affecting the indexes.
You know, Matt, you make a compelling case, but I don't think that's quite it, of course. Matt is being facetious here. You have a whole lot of nothing if you take a look at, of course, the first seconds of trading at your big benchmark level, the S&P 500, down a little bit. Same thing, too, if you take a look at the NASDAQ 100, your big tech stocks. But, of course, we're coming off two very volatile days. And the question is, I mean, what is going to be the catalyst here? Is it going to be earnings? Is it going to be the Fed? Of course, and we have the election 26 days away. But you add it all together right now, pretty quiet. Let's get to some stocks underneath the hood because we do have some action when it comes to Arcadium Lithium. Of course, Rio Tinto will buy that miner in an all-cash deal valued at $6.7 billion. The reason why you're seeing this big pop is because that's a 90% premium from Arcadium's closing price last Friday. And as Matt mentioned, of course, we are keeping an eye on Alphabet. The Justice Department may ask a judge to force the tech giant to break up its business over concerns of monopolization of the internet, search, and ad space. Bloomberg News and other outlets, of course, have been following this very closely. It's been a weight on the stock for the last 3 months. And as such, maybe not a huge surprise today. You can see the stock pretty much unchanged, Matt.
All right, so not moving the price at all, but still a very interesting story. Also, Boeing has withdrawn its contract offer with the union that's been on strike for nearly a month. The impasse leaves both sides with no clear path forward as S&P Global says it may cut the plane maker's credit rating to junk. Let's talk about that with Bloomberg Global Aviation editor Benedict Kamel. And Benny, it's interesting, you know, even though they're going to lose, Boeing will lose, I guess, $1.5 billion a month. At least that's what JP Morgan estimates, as long as this strike goes on. They're not really over a barrel the way the ports were with the longshoremen, so they're not in a huge hurry to finish this strike.
Well, it depends who you talk to. S&P made pretty clear yesterday that there is a certain urgency to the talks. S&P predicts that it's about $1 billion that's rushing out of Boeing's coffers every month. And this is a company that already came into this strike financially weakened. You know, they've been losing cash since the start of the year, and the question really is, who blinks first? They came into the talks on Monday, the unions and Boeing, and it was looking kind of hopeful they would get back to the table at the very least after 2 weeks of no talks. And now here we are 2 days later, and they've broken off again. So it's unclear what will bring them back, who's going to feel more pressure. As you said, Boeing does have some pressure in terms of the finances, but so do the workers. You know, they no longer get their paychecks, the health benefits have ended, so at some point, something will have to give.
Well, to your point, I would imagine, and who am I, but I would imagine that Boeing feels more urgency here when you think about that incredible cash drain. Of course, S&P Global knocking on the door saying, hey, we might downgrade you. And on the union side, I mean, I imagine that the leadership is taking a look at the enormous raises that the longshoremen just secured and saying, why not us?
Yeah, I mean, there is a bit of a gap between what was just achieved on the port side and the numbers that are out there on the Boeing side. The last Boeing offer now taken back was 30% wage increase. That's obviously just about half of what the harbor workers achieved. The workers want something closer to 40%, and that's probably a number that they can agree on. The sticking point really is not so much the wages, but the pensions. That's something that the workers want reinstated, an old pension plan that they lost during the last wage talks, and that to Boeing is a real red line. And that might also be the reason why talks broke down again, and Boeing made very clear, we cannot follow you in that demand. They said that the workers wanted something that wouldn't have been viable for Boeing if they wanted to stay in business. So that probably is their red line, and at some point the workers might come around. For now, it looks like a fairly uniform sort of approach, but at some point, particularly younger workers might say, you know what, 35, 40%, that doesn't look so bad, and I'd rather do that and get the money than be camping out here for another couple of months, you know, as winter approaches. So if Boeing can drive some kind of a wedge into the worker front, then they might have an edge.
All right, Benny, great reporting, great context as always. That is Bloomberg's Benedict Kamel reporting on Boeing. Of course, shares down another 3.5% today, down more than 40% in 2024. Just amazing to watch that. Meanwhile, let's broaden out this conversation and bring in Max Kettner. He is HSBC Chief Multi-Asset Strategist. And of course, over here in the States, we're taking a look at CPI tomorrow. And after that blowout jobs report that we got last week, feels like the stakes have been raised on CPI. You had Bank of America coming out and saying that stocks, they can withstand a slight upside surprise in inflation, but a sizable surprise that might be too much to stomach. How are you thinking about the balance of risks as we count down?
Yeah, good morning and good afternoon. Thanks for having me. Look, I think on the CPI, probably the narrative has changed so much and shifted so much that a couple of basis points of an upside surprise, even on the headline, would already be enough to sort of really keep the trade going that we've had ever since last week, or really the last week and a half. So a bit more sort of a reversal of Q3, long the cyclicals, short the bond proxies, short the defensives, you know, really, really long on equities and on the cyclicals against US rates in particular that are still not really priced for the US actually still being in a really good place from a growth perspective. So I think a couple of basis points here, a bit of an upside surprise tomorrow is already enough to just put a bit more fuel on the fire of that. I wouldn't, however, say that there's a big potential for an enormous upside surprise, particularly on the headline, given that oil prices up until a couple of days ago, of course, have been fairly range bound to slightly down. So if anything, that probably should keep the headline somewhere close to 0.1 on the month.
And let's talk a little bit more about defensives, which you bring up, because actually Bill Gross, of course, released his latest investment outcome a little bit earlier this morning. He's the bond king, but he talks about stocks now, and he's shifting to defensive stocks. He says that it's no bear market, but it's not the same bull market anymore. And as such, he recommends keeping exposure at average levels, but focusing on defensive stocks here. Talk us through a little bit what you see as the different push-pull factors in defensives.
On that, I must be very honest, I could not disagree more. I think this is not the time to go into defensives. I think one of the things that really is massively underappreciated still is when we look at the last week and a half, where we had the revisions to the national accounts data in the US. Quite frankly, never in my life have I ever seen a set of data, a set of revisions, where every single subset of the data was revised higher. Whether that is GDP or gross domestic income, whether that was profits. Remember, profits were revised higher by almost 12%. You know, you had incomes revised higher, dividend income, interest income, wages and salaries. Every single thing has been revised higher. So savings as well, right? We thought that excess savings would be running out, and look at the savings rate. It's like below 3%. So under the hood, the US consumer is feeling much more of a strain already. Well, the reality is that the savings rate is above 5%. So it does look that the US consumer is in a much, much better state. And when we look at consumer spending, debit card spending, look at the Chicago Fed's weekly retail sales, look at weekly same-store retail sales, all of that stuff has been picking up since early August. So frankly, I think we've been massively underestimating how strong the US economy is. I think we've all been massively overestimating that payroll number, that July payroll number. And I think a lot of people are now sort of really forced into unwinding those Q3 trades. And therefore, I think that cyclical trade, particularly combined with you guys been talking about what is the next catalyst, particularly combined with the earnings season now coming up. And let's remember, if you exclude, for example, tech from consensus earnings expectations, then earnings are actually expected to decline quarter on quarter in an environment where GDP probably has gone up by almost 6% nominal GDP, which is just crazy. So you've got such an utterly low bar to beat on earnings expectations that, frankly, I think really the place to be is cyclicals now.
So, Matt, Max disagrees with Bill Gross, but you have to remember, Bill Gross is a bond guy. He's biased to be defensive here and to be a little bit scared.
Also, Bill has been, and Max is up and coming. Yeah. Max, what do you think about the Fed path here? You know, 50 basis points. After that, I thought maybe there's a chance they go again. There were some economists who were saying, I think Michael Feroli, you know, if we get a big miss on the labor number, you could see another 50 in November. And that, I would think, just supports your bullishness for stocks. Now that we get the blowout jobs number and the revisions up, I feel like the Fed doesn't really have to do 50 or even 25. I mean, they could do just one more rate cut this year and it would be fine, especially if inflation it surprises to the upside a little bit. Is it a threat to your bull case if we have rates, you know, not being cut as quickly?
No, I don't think so. I think, yes, the case for 50 certainly is no longer there, but I think for the Fed to even stop with rate cuts at all, even in November, would be a complete shift from what they've said in Jackson Hole, what they've said during the September meeting, what Powell has just said last week. So it would be a very sudden shift away from that. And let's remember, the inflation outlook hasn't changed suddenly overnight. So it's not like everything's gone suddenly way more hawkish. So a series of 25 basis point cuts is really still makes sense, at least the next couple of meetings. And that is still really good for stocks. Let's remember that the last, let's say, 2 years, where did stocks, where did spreads, where did risk assets really get under pressure? It was the pain point always was reached when you basically were switching from, okay, they're probably not going to cut at all, and they may even have to hike. That was always the pain point. That was April, May this year. It was August, September, October last year. It was never really, well, they're going to cut a bit less than we thought. That's totally fine. Equities, spreads, risk assets in general are totally fine with that. I think once the narrative changes to, actually, this is it, they're not going to cut at all, and or they may even have to hike. That is the pain point where I think risk assets will really start to struggle. And quite frankly, we're far away from that point.
Max, great to touch base with you. Love to get your take. Max Kettner there is Chief Multi-Asset Strategist at the Hong Kong Shanghai Banking Corporation. When we come back, we're going to get more from Sonali at Citadel. This is Bloomberg.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I'm Sonali Basak, and this is Bloomberg Open Interest here today at the Citadel Securities Global Macro Conference. And I am with the market makers global head of rates, Mike DePass. You have about 150 clients here, hedge funds, asset managers, institutions, central banks, a lot of central bankers, even former politicians here today. How has Citadel Securities grown and evolved? This used to be a company mostly known for equity market making, but very noticeably pushing hard into the world of rates and credit.
Yeah, thanks for having me, Sonali. So we're really, really proud of the growth of our franchise over the last really 8 years. The focus for us of late has been launching our credit business, which has been phenomenal. We're off to a great start, making a real market impact there. Elsewhere in fixed income, we're focused on our European rates expansion. We expect to be fully live in Europe across a variety of products by the end of the year. And also, really, the biggest evolution for us as a franchise has been that deepening of relationships with exactly those clients that you mentioned, where we are now seen as a trusted liquidity provider, source of liquidity for large risk transfers, complex trades, really adding value to our clients in the way that they really, really need.
You're getting a very intimate place in the marketplace right now, and we're less than 24 hours, as I sit with you today, from that next inflation print, presumably the next big market moment.
Yeah.
What is your expectation?
So it's quite interesting because the market had shifted all of its focus and really all of its vol expectations into the payroll reports going forward, with an expectation that they would be weak and it would sort of force the Fed to be more aggressive than maybe we had initially thought. Now we've seen a quite strong payroll report last week, and the attention now turns to inflation once again, where you say, well, the growth dynamic now looks pretty solid. Do we have to be concerned about inflation maybe not getting to target? How does it change the Fed reaction function? So for tomorrow, we're looking for a print that puts core in the high 20s, gets you to an inflation environment around 2.5%, 3%, still well above target, and still leaving the Fed with a dual mandate to manage.
Well, so what does that mean in terms of your expectation for how much the Fed can cut rates this year?
Yeah, so right now we see the market, and it's repriced materially, but we're still implying 50 basis points of cuts for this year. And I think when we look at it, whether it's the strength of the underlying economy or the stickiness on the inflation front, that feels a bit too high. So I'll go out on a limb and say we only end up seeing 25 basis points of cuts again for the rest of the year.
That's a call. And it's interesting. You have seen more folks turn tactically short in the market, as our own Bloomberg's Liz McCormick points out. Do you think that implies that people can be short even further, given where the market is now and what you expect, which is only 25?
Yeah, it certainly would have an impact on the very short end of the curve. So there's room to trade this market tactically, and I think that's really going to be the biggest message and biggest dynamic going forward. Is the economy is in a bit of an inflection point. There are a lot of cross currents, and I think you're going to get an opportunity to trade what we expect to be material volatility going forward.
Material volatility, it was incredible. A year ago, when we sat here, your clients had an incredible range of outcomes here for what the short end would look like. What does that look like going into the end of next year? We had Esther George apparently saying you can't even really rule out a hike next year.
Yeah. Well, I think getting the Fed in a position where they would consider hikes is going to be quite difficult. I think what's much more likely is we end up in a world where inflation remains sticky above target and the pace of easing slows down relative to what the market has priced in. But again, I think the opinions are so wide and so varied that we're once again going to see a market that responds aggressively, likely over-responds aggressively to one or two data points, and we're going to get quite a wide range again in the front end of the curve.
You can call it the Citadel Securities spread this year. Michael DePass, thank you so much for joining us. Looking forward to the rest of the conference. Katie, back to you.
All right, Shanali, thank you. Of course, Shanali, we'll have more from the Citadel Securities Global Macro Conference throughout the day, including an interview with the CEO of Citadel Securities. Coming up on this program, will they or won't they? Couche-Tard has a fresh proposal for the owner of 7-Eleven stores. We'll bring you the latest in M&A next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks. Of course, 22 minutes since those bells rang, and not a lot is happening. If you take a look at the S&P 500, currently flat on the day. A little bit more action to the downside when it comes to your big tech names, currently off by about 0.2% on the NASDAQ 100. And your small caps, the Russell 2000, hanging in, holding steady, rather. You take a look at the Russell 2000, I'm going to call that flat, too. Meanwhile, let's move to M&A land because we do have some action there. When it comes to Couche-Tard, it has sent the owner of 7-Eleven stores a fresh offer worth $47 billion. The Canadian company still trying to take over the Japanese retailer after its initial bid was rejected. Joining us now is Bloomberg Deals reporter Crystal C. And this is a 20% premium to their previous offer. They really want this company.
Hang on, can we also just congratulate Katie for saying Couche-Tard correctly?
I hate saying that.
On the first try.
I had to put it phonetically in the prompter.
Couche-Tard?
Couche-Tard.
Right,
I don't know. Anyway.
You got it right.
Thank you.
So it went from 1486 to 1890. So it's a significant bump, and it shows that, you know, Couche-Tard is still there. They still really want to go for this. There was a little bit of like, will they, won't they at one point? Will they actually? Couche-Tard doesn't have like the smoothest, most flawless M&A track record. They have approached many big things. If you remember, like Carrefour was one of them. There are a bunch of European assets that they've looked at. So this one is showing that they're back. They really want to do it. But the reality is not a lot has changed. Their previous bid was rejected, and they haven't opened book. They haven't seen any more information since the last bid. So it's going to be whatever they see from now on. It's going to determine what's the next step.
I read what I found fascinating about 7 & I, which owns obviously 7-Eleven. We're showing some Japanese 7-Eleven footage there, but also the Circle K. And they have applied for and received core company status in Japan, meaning they're vital to the national security of Japan. Is this like retaliation for U.S. Steel, or what's going on?
So the argument here is there's a hurricane going on in the U.S. There are a lot of tsunamis, typhoons that happen in Japan. And when those things happen, 7-Eleven as a retailer, because of the span that they have in the country, they're essential in distributing emergency supply to the Japanese.
Wait, so the 7-Eleven workers, if there's a tsunami, they're still coming into work and handing out like Starburst.
Whatever supply you need, your karage, you know, your whatever cup noodle that you want, like you can still find it at 7-Eleven. It could be trickled down from like the government, but you know, like just because of their footprint, they play a very essential role in the Japanese society. Not to mention, it's a lower cost food alternative for a lot of, you know,
so not retaliation for U.S. Steel.
I mean, you can look at it both ways.
Yeah.
An official party line, that's not what they're looking for.
All right, we have less than a minute left with you, but 7 & I, it's scheduled to report its results today, actually. I would imagine that they're going to face some questions about why they are saying no and whether they'll say no to this one.
Yeah, they haven't really said anything this time, like after the bump. So after earnings, it's also interesting to see what Couche-Tard would think. You know, based on the performance of the quarter, again, like they haven't really seen anything in private. Numbers-wise, they really have to rely on today's data.
All right, Couche-Tard obviously is Canadian.
Right.
Anyway, so I guess it wouldn't really be retaliation, but is it Quebecois?
North America.
Yeah, North American retaliation. Crystal, thanks so much. Crystal C covers the deals for us. Coming up in the next hour, we're going to talk to the VP of FICO scores about the uptick in missed credit payments. Then Admiral James Stavridis joins us with his new book and talk about geopolitical risks. This is Bloomberg.
reach down to the 18 to 35-year-old market. How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. We made it back from Orlando. We're also streaming live on YouTube. So head over to youtube.com, search Bloomberg Live Radio, and that's where you'll find us. Coming up, we're going to take a look at big tech. It looks like the U.S. is getting serious about some of these big tech companies, particularly Google here, maybe talking about a breakup. We'll talk to Mandeep Singh of Bloomberg Intelligence, whether this is really a risk or not. And to current Bloomberg, a global economy report will give us the latest on what's happening in China. It seems like that China trade lasted all of about a cup of coffee, as Tom Keene would say. So Shelby McFadden, investment analyst at Motley Fool Asset Management, will give us her thoughts on these markets. We got a lot coming up in the next couple of hours, but first, let's kick it all off.
All right, Paul and Alex, we are being brought to you by Interactive Brokers Portfolio Analysts. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/free-PA. Right now, the major averages, they are mixed. S&P 500 up 4 points at 57.55. The Dow Jones Industrial average up 156 points. That's a rise of 0.4%. The tech was in the lead yesterday. Right now, the NASDAQ 100 down 30 points. That's a decline of about 0.2%. As fears of crackdowns on big tech, they've been around for a while, but the prospect of an actual breakup push for Google weighing on sentiment. Nora's going to be along in a few minutes with more on the Google story. Tomorrow's Consumer Price Index report, that may move markets, but Bloomberg Intelligence Chief U.S. Rate Strategist Ira Jersey, he says he's more focused on next week's retail sales data for a signal of consumer spending health. We're also going to start to get the earnings for the big banks. That starts Friday. Chinese stocks suffering their biggest drop in more than 4 years. Traders grew a little impatient over the pace of the stimulus measures from Beijing. The CSI 300 index that plunged 7.1%. And a quick look at Tesla. Those shares right now down about 0.8%. Even though they enjoyed the best ever quarter for China shipments, vehicles delivered from its Shanghai factory rose for a third consecutive month. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex, welcome back.
Did you miss us?
Yeah, I actually did.
We did notice that this was the first trip you didn't seem upset not to go on. I
still would have gone.
You still would have gone? Yeah.
Absolutely.
I mean, there's nothing like, pool and stuff with the rain. There's nothing that beats that.
Still a lot of indoor events at Disney World.
Yes, I wouldn't know. That was Paul.
See, we got the rain poncho game was very strong for me, at the park. That's all you need.
I know. Are you picturing it? It's funny, right? Yeah. No, I'm with you.
Did you have the ears?
No, I did not have the ears.
The guy has standards, okay?
Yeah,
he has some
fun,
standards.
I spent a lot of money there, John, for 2 days. I mean, so Disney, if they have a good quarter this quarter, you're going to know why.
Yeah, you know what? You're going to spend more money now on Disney. They're increasing some of their park tickets.
I saw that.
He says Space Mountain was his favorite ride.
Space Mountain is awesome. Oh my God, it's the best. When was the last time you were on Space Mountain?
When I was a little kid.
I know, it brought back
So
memories.
it's not cool anymore?
It's not cool anymore. The rock and roll roller coaster, I think, is just awesome.
Rock and roll roller coaster?
That's next to the house, where the elevator drops thing.
Yeah.
The Haunted Mansion, whatever thing.
Is it still there? Is this from the 1910s? All right, thanks, John Tucker. I really appreciate that. Let's get to some more here. Let's focus up. Let's get to some of the movers on the day. Norma Linda joins us now. She is Bloomberg Equities reporter. So no comments on Space Mountain or anything, but we are looking at Boeing. So now we're into some serious stuff. Now we're getting more warnings from some rating agencies on junk. Tell me what's going on with the stock.
Yeah, I mean, Boeing has really had quite the year. I mean, when we reflect on all that's gone on, it's really been an embattled company. We're seeing shares down 42% year to date. And today we have even more news coming out. And this is after the company said that negotiations to end an almost month-long strike have collapsed. The plane maker is withdrawing its contract offer, saying that the workers' union did not seriously consider its proposals. And so we did have the S&P Global Ratings looking at a downgrade of the company's credit grades to junk. This is not good. I mean, Jeffries said that the union talks falling through, the strike may get dragged out, and this can really put some serious pressure, even more pressure, on the 737 MAX supply chain.
It's interesting. I mean, this is really interesting. It feels like the workers the union has most, if not all, the leverage. That being the case, if I'm Boeing, I'm like, I just got to get a deal done. And I'll come back and revisit this thing in 4 years and try to get it back. But man, because it's a balance sheet cash flow issue for them. So
Exactly.
It's really tough spot.
Something they got to figure out soon.
Talk about tough spot. We will talk about this more in depth with Mandeep Singh in just a second. But Google/Alphabet, Terry Haynes wrote that he's like, this is not going to be a thing. This is just a blustering situation. This is not going to be very dramatic for Google. But nonetheless.
See, because that's what I'm wondering myself. I mean, I think we've really seen this increasing pressure on tech stocks more broadly as we think about antitrust. And of course, this is a big headline of the day, but I'm really curious to see how this really filters out. But of course, we do have Alphabet shares falling after the U.S. Department of Justice is weighing breaking up Google. And as I was doing some research, it seems as though that could be like one of the most extensive things that they do, one of the harshest things that could happen to the company. But of course, when we think back to Microsoft, they used to have conflict around this and whatnot. But I mean, they didn't end up having to break up, and it just kind of messed up some of their acquisitions that were going on during that time when they were receiving that pressure. So it's really interesting to see whether or not Google will actually be forced to sell parts of its operations. But right now, we're seeing shares down as much as 2.1%.
And what's the timeline for this? Because we were quoting one of the legal experts who said the appeals process, this would be another
ever.
5 years.
Oh, yeah.
5 years.
How do you price that in?
Yeah, but I checked, and we'll talk to Mandeep in just a moment, but I went to his research on the Bloomberg terminal. He says they're going to have to do something here. This is not, so we'll talk to Mandeep and get some details on that.
Can't roll off the back.
Yep. All right, China, that trade, that lasted about 15 minutes.
Yep. Right. I mean, when I was When I was last looking, we saw shares of the NASDAQ Golden Dragon down as much as 3%. And this is after we just watched, trading in China. We saw stocks in China plunging as much as 7.1%. Of course, we have investors really thinking about this China stimulus. We were hearing that they were, anxious and becoming a bit more impatient over the pace of Beijing's stimulus measures. So that's definitely an area that I've been tracking, especially as it ripples into different sectors here in the U.S.
All right, Nora, thanks a lot. Really appreciate Norma Linda joining us from Bloomberg Equities team. There is another meeting, though, I think, Paul, when it comes to Chinese equities this weekend. It looks like the finance minister is going to hold a briefing on Saturday that could introduce new moves aimed at strengthening fiscal policy. That's where we'll get an idea of how much bonds they're going to issue and then what the stimulus measures and more spending will be. But, TBD, ...
Yeah, all right. We got monetary stimulus. That was an initial run-up for the market stimulus. But now the experts are saying that's not enough. We need some fiscal stimulus as well for this economy. And we, as you mentioned, we'll get something this weekend, but we haven't heard much. And that kind of disappointed a lot of investors.
Or just not enough, right? Like 200 billion yuan is different than like 3 trillion, which is somebody was somewhere actually expecting. Let's get back to the other story of the morning, and that is what's happening with Google. So joining us is Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, on a potential Google breakup. Okay. So the DOJ considering asking a federal judge to force Google to sell off parts of its business. What do you think is actually going to happen?
Well, so there are 3 big lawsuits out there against Google in the U.S. 2 from DOJ. One is the monopoly lawsuit, which they lost, and that's where we are looking at remedies. The other one is also from DOJ against their ad tech business, where the DOJ is looking at their ad tech stack and how, they control all parts of the stack. The third one is from the different state attorney generals, again, targeting their ad tech business. So when I look at, everything that obviously regulators want to change with Google, the ad tech piece is the one which comes up over and over again, the fact that they control different parts of the ad stack. Now, in the monopoly lawsuit, they're talking about a forced breakup of the Chrome business or the Play Store business, Android business. I think it's very hard to take out, a single product from a company like Google and say this is a separate entity. It's just like, it's all run on shared infrastructure. I can't imagine, doing that with Google and doing it successfully in the sense that Android can be a separate company. Maybe YouTube, but again, with YouTube, it's run on that same infrastructure that search is run on. So how do you split that infrastructure? It's very hard to do it at the product level.
All right, here's some inside Bloomberg for you. You want to get really smart on a new piece of information that just hit the tape about a company? Type in the ticker, GOOGL for Google, hit equity, and then hit BICO, B-I-C-O for Bloomberg Intelligence Company Research, and you'll get what's called a recent event reaction. So I want to know immediately what Mandeep Singh thinks about this stuff. And what I read, I didn't expect to read. We see a breakup of Google's ad tech business as the most likely outcome for remedy in the company's monopoly case with the U.S. Justice Department. I thought what I would have read is, don't worry about it. But this has some teeth here. This is what you're kind of telling me.
Well, because they lost that first lawsuit at the DOJ, and the second one, the ad tech as well, it's very likely that the judge will rule against Google. Okay. So when you lose the cases, there has to be both behavior and structural remedy. And in the case of behavior remedy, they can't make those payments to Apple anymore to be the default search or any other hardware maker. They'll have to open up Android to offer search screens so that you just don't have to use Chrome or Google search. You can use Bing search, for example. So choice screens is another behavior remedy. But the structural remedy in terms of a forced sale, I find it hard to believe that the DOJ will ask them to sell a product. It has to be more at the technology stack level.
So when we go to the ad tech stack, maybe that just dovetails with what you were saying. So what does control the ad tech stack mean when you're talking about Google?
So think of how an ad exchange works. Okay. You have the supply side, in terms of the publisher ad inventory, and then you have the demand side, the advertisers who are buying those ads. And then you have the exchange in the middle who is matching the supply and the demand side for ads. Google has products across the stack where they have a demand side platform, they have a supply side ad platform, they are an online exchange. And they've built it over the years because they made a few acquisitions. DoubleClick was the most notable one, where they acquired all the capabilities to really operate as an entity that knows everything when it comes to digital ads being sold in the marketplace. So they control that stack end to end. That's why when you compare Google's ad pricing to everyone else out there, they are far superior. One, they have the best targeting. The other is when you're operating a stack where you have the dominant product across the different pieces, you have a pricing advantage. And that's what, the regulators are saying, that this company controls pretty much everything in the ad stack.
But the advertisers themselves, they're not complaining.
Of course not. I mean, they're getting the ROI on their ad spend.
Who are they protecting?
This is a solution in search of a problem here, in my opinion, because I have competition in this market. I think I have competition. I mean, Google's huge, but so's Facebook. And now I got this little company out of Seattle called Amazon. They're a monstrous advertising player.
Yeah.
So where's the problem here?
So it all comes down to how you look at the market. If you look at the market the way you just described, where Meta is as formidable as Google and Amazon is a big third player, then yes, there is competition. But when you look at certain type of ads, whether it's on the desktop or, the third-party ads that are going through Google Ad Exchange, these companies don't overlap. Like, remember, Meta is a walled garden. Even though it's big in terms of the digital ad advertising, it's its own walled garden. Amazon is its own walled garden. Google, so these companies have their own swim lanes. They are big in terms of the digital ad dollars, but they have their own swim lanes. They don't overlap. And that's the objection that I think regulators have.
Okay, so if they wound up, moving around that ad tech stack and changing stuff up, what does that change look like, and how much money could then Google lose?
Well, so Google Search obviously is a $200 billion run rate business, still the cash cow for Google.
That's unreal.
So that's where, the Google network piece, which is the ads that Google shows on third-party platforms. So one is Google showing ads on YouTube and their own search page. The other is Google showing ad on, let's say, a New York Times or some other publisher, because it's going through the Google Ad Exchange. That's the part that can be divested and it's a $32 billion run rate business within that $200 billion. That's the part that's not growing, but you could argue could be split up in a way where I think Google may be a smaller search ad business, but at the same time, that will appease the regulators because they're not controlling different parts of the ad stack.
When you talk to institutional investors out there these days, how do they think about the regulatory risk over big tech these days? And how has that changed over the last 3 or 4 years?
I mean, right now, everyone wants to know who will be the dominant player when it comes to LLMs and, generative AI, whether Google will end up losing its dominance in search because of these LLM players. And that's where I think, again, the products that Google has, whether it's Android or YouTube or cloud, they're critical to maintaining Google's lead in that LLM and